Hello everyone, welcome to uh, Algorithmic Trading Workshop 2023. Now this month, as many of you already know, we are celebrating our 13th anniversary and we are happy to bring you this 3-hour workshop where we are going to cover two sessions. Uh, both the sessions are 1.5 each, and the first session will be on the foundation of algorithmic trading using Python, which will be conducted by Vivek Krishnamoorthy. And second session, a practical implementation integrating Python, machine learning, and large language models. This will be conducted by Varun Pothula. Now, I think without taking much more time, let's welcome our first speaker of the day. Hey Vivek, uh, how are you doing? Can you see me? Can you hear me? Hi there.
Hi, Kshitij. I'm very good. I hope you're doing good too.
I'm doing great, thank you. And thanks for taking out your time, Vivek, and uh, agreeing on conducting first session for this workshop. So now the thing is, I'm going to make you the presenter, okay? And while I'm making you the presenter, I'll also quickly do basically an introduction, like I'll introduce you. So let me just make you the presenter. So you'll be able to see it on your screen. Yeah, we can see your screen. Okay, so a quick introduction to Vivek. Vivek Krishnamurthy, Head of Content and Research at QuantInsti. And Vivek loves to teach data analysis, building quant strategies, and time series analysis using Python. He has over 15 years of experience across India, Singapore, Canada in industry, academia, and research. He is the co-author of the book Python Basics with illustrations from financial markets, and another one which is called A Rough and Ready Guide to Algorithmic Trading. Now, he has a bachelor's in electronics and telecom engineering from Mumbai University and an MBA from Nanyang Technological University in Singapore. Now, with that introduction, before we start, I would like to tell everyone that please note that in this first session of this workshop, in case if you have any questions, so generally we conduct sessions for 1 hour. This is going to be 1.5 hour long session, and in case any of you have any questions, make sure that you are putting your questions in the questions panel, and once the presentation is done, we'll try to pick as many questions as possible after that presentation. Okay, so with that said, I think we can start now. Let's dive straight into the workshop of the day, and Vivek, the stage is yours.
Thank you, Kshitij. Appreciate it. All right, great. I just love these sessions, guys. These webinars where I get to talk to so many of you. I mean, it's usually a one-way communication. I get to hear and see what you guys have to say via the chat window. But nevertheless, it's always fun to see what people are interested in, what they're up to, what their backgrounds are, and how they're looking to up their game. All right, so now what I'm going to do is I'm going to put my screen on slideshow mode. So hopefully you should be able to see my screen. Kshitij will I speak to me. I can't see the questions window right now, but I'm sure Kshitij will let me know if my audio or video is not working. All right.
Yes,
So
Vivek. We can see your screen, and I'm also going to make you the organizer so that you can also see the questions panel going ahead. So now you may be able to see the questions panel.
as you can see, the workshop today is titled Building Algo Trading Strategies Using Python, AI, and ChatGPT. So all these three are new age tools, and they've become part of the lexicon of quant finance at different times, I'd say, in terms of popularity and in terms of mass usage. So what I'm going to talk about is really the foundations, and my very illustrious colleague Varun is going to take the second part where he'll talk more on the AI and the chat GPT part. My focus is going to be more on the Python part, right? So this is like a customary disclaimer. Whatever I'm covering here, whatever Varun will also be covering is meant for education and information. This is not investment advice. We don't know you, we don't know your backgrounds, and we are not financial advisors in any capacity, right? I'm referring to QuantInsti here. So let's start with a poll. Kshitij, I think there are two questions which should give us an idea of this audience, something I always like to know. So please, you can share the poll with the audience, one after the other.
Sure. So as all of you can see, the question is how familiar are you with programming or coding? So these are the options. I have never programmed before. I have programmed many years ago. I have occasionally used programming languages, and I'm quite comfortable with programming. So far I can see that around 30% people have answered. Now the answer is crossing 50. Okay. So 10 more seconds, I think we'll wait. So far, we have received response from almost 70% of the people. All right, I'm going to close the poll and show the results. So the results are here. So wow, that's amazing. So as all of you can see, 44% of our audience is comfortable with programming. And at the second position, we have 26% audience that has occasionally used programming languages, followed by 20% who have never programmed before. And the last option is I have programmed many years ago. So I'm going to hide the results now so that presentation can resume.
No, Kshitij, you can share the second one also. So
Oh, sure.
together they will, yeah.
So I'm launching the second one. And yeah, as you can see, how familiar are you with trading in the financial markets? Uh, one being that you are new, and five means that you are an expert. So all of you can start answering this poll. So if you are not familiar with trading in the financial markets, you can simply say one. And if you are a professional trader, then you can go for five. And if you feel you are in between somewhere, you can opt for two, three, or four. Great. I think 70% of the audience has already answered. So let's close this poll and let's see the results. All right. So most of the audience, like around 32%, is rating themselves as three. So somewhere in between. And in second position, it's a close fight actually, between four, one, and two. So yeah, and only
Great,
11% of the audience is saying that they are expert at it. Okay, I'm going to hide the results now and let's resume with the presentation.
great. So this is like almost like the ideal audience that I like to talk to, because I see that people. So there's a mix. I can see that there are people who are 50% of the folks are comfortable with programming, and the rest are at different levels. And same I can see with finance familiarity also. So it's a beautiful mix, and I think hopefully this at the time that you spend here, the next 2.5 3 years, should be worth your while for both kinds of people, people who are familiar with the programming as well as those who are more familiar with the market side. All right, so let's move on. As far as the part that I'm covering goes, over the next hour or so, what I'm going to do is, my purpose of this, the time I spend with you, is to give you guys a quick tour of general quant analysis that we do when we speak about algorithmic trading. And while I do that, I'm going to go over what we mean by algorithmic trading, why specifically why is the field so fixated with Python. We'll then spend a little bit of time looking at how we install Python and work with all the popular libraries that make it so powerful in quant finance. We'll try and see what we mean by data, right? Data seems to be everywhere these days, right? Data science has been around for many years, and pretty much every field of human endeavor is now affected by the presence of data and how it's altered their industries. We will also spend some time playing a little bit with market data. We'll backtest a quant strategy, and then we should have some time to also take a look at the research and trading platform that we have in-house. It's called Blueshift. And at the very end, I'm going to talk about the workflow of writing trading algorithms. So hopefully that should stitch together all the previous points that we would have seen. I've deliberately put it at the very end because the chart will make a little more sense to you once we've gone through the previous steps. As you can see, I've color coded the points here because my entire presentation is going to kind of span three different things. We'll spend some time on the slide deck. We're going to spend some time in a Jupyter notebook, and we'll spend some time on the Blueshift platform, right? Okay, so let's start with what is algorithmic trading. Very simply put, it's about using computer programs. So when we use computer programs to make trading and investment decisions, we call it algorithmic trading. It has many, stripes and checks, and depending on where, what kind of trading we are referring to. As I mentioned here, it can vary significantly if you look at it along the axis of complexity. By complexity, what I mean is we are talking about the amount of computing power that you need, the kind of data sets that you want to refer to when you start making trading algorithms, as well as the mathematical sophistication involved in the kind of analysis that we do. I would say at the very beginning, it's primarily about using what I call technical analysis indicators. So you have moving averages, you have RSI, you have Bollinger Bands, and several others that you use, and you try to create certain rules for buy and sell. You may also want to create rules for things like take profit and stop loss, for better risk management and for better management of your portfolio. If you move beyond that, then you have approaches like pairs trading, where you're looking essentially at pairs of assets which have some sort of correlation between them, and based on how their behavior changes over time, you try to take positions. So this involves some comfort with statistical analysis, because that is how we monitor the behavior of these correlated assets that we're talking about. These assets could be, they typically are firms from the same sector. So for instance, it could be Pepsi and Coca-Cola. It could be a pair. You could have pairs like two firms from the same industry. So it could be two automobile firms and so on. If you want to go slightly beyond that, you have machine learning based strategies. I won't dwell too much here because Varun is going to talk to you guys more on machine learning and its approaches. But to give you a brief idea of what I mean here, it is the usage of things like supervised learning and unsupervised learning in order to create trading strategies. So supervised would include all your regression, classification sort of approaches, and your unsupervised would have things like clustering and so on. You also then have high frequency trading, which is, I would say, like a field unto itself, because here the requirements change quite a bit, because here now you also need to have infrastructure, and I'm talking about hardware here, right? So you might need to have, in fact, need to have co-located servers which exist at the exchange. You also need to have high computing power, because we are now talking about taking positions and taking trades for fractions of seconds, as opposed to holding onto your assets for a few minutes or a few hours or a few days, right? So the approach also changes. The types of, I would say, algorithmic trading that occurs in high frequency would be typically things like market making. It could also be things like arbitrage that you try to find. And if you look at other, I'd say, slightly more sophisticated approaches to creating trading algorithms, you have things like deep learning, you have neural networks. So these are, again, some of the sexier things that people do these days. How useful they are and all of that is still, I mean, we haven't used it all that much, so the jury, I'd say, is still out on that. But nevertheless, there's a lot of exciting work that happens here. There's also natural language processing, which is analysis of text-based data. So this could be news articles, it could be tweets put out by firms, as well as people who hold important positions in firms. So tweets by, say, someone like an Elon Musk or say a Satya Nadella, those kind of tweets could move markets with regard to their sectors and their firms. So that's what essentially NLP is trying to do. It's trying to capture any kind of potential insights that could occur in textual data. Now let's come to why are we referring to Python so much, right? Everyone seems to be talking about it. Well, Python has become like the lingua franca, like the way the English language has become for humans. It's kind of become like that for quant finance now for the last nearly 15, 20 years. And many different libraries and systems have got developed on top of Python, right? You have so many different libraries and specific to fields, including our field, which are all Python based. One of the key reasons it's become so popular is because it's open source, and because it's open source, it's free. So the entry barriers to installing Python on systems is very, very low, right? You don't have prohibitive license costs. You've also got a very active developer community who are working quite actively to come up with newer libraries which fulfill certain requirements that users have, right? Another very nice feature about this language is that the same language that you use for researching certain ideas and working on them can be the same one that you take on to production, right? So the same, so you don't need to kind of rewrite your program in another language when you want to take your strategies live. So that is an important criteria, and it also in general makes it more attractive for folks who work in the field of financial markets, right? Now, when you talk about installing Python, there are multiple ways you can do it. I would say the one that I would recommend is to, let me open Anaconda here. So if you go to anaconda.com, it is a popular distribution for using Python. So if you go and click on, say, free download on this website, it lets you download what you need. So there are, as you can see, it says it's a free install. There are thousands of packages that you need. And you can see that there are installers for all three architectures. You have it for Windows, Apple, as well as Linux-based distributions. So in case you guys don't have it, I would say you can choose one of these based on your systems and what you use, all right? So there are many different distributions out there. There's Anaconda, which I just recommended you. There's also PyCharm and ActiveState and many others, right? Now, when you specifically talk about Python with respect to quant finance and machine learning, what you see on your screen here is Python at the center of it all, and all of the important constellation of libraries that get used. So you will see different names here. You have NumPy, which is, I'd say, probably the most important library that exists in this ecosystem, because all of the heavy lifting of computation is done via NumPy. And many libraries are built on top of NumPy, such as Pandas, which is used a lot in quant finance because it handles market data really well. You have TAlib, which has got technical analysis indicators, a lot of them. So that is also used quite a bit. You have Matplotlib, which is used for charting. You have PyFolio, which is used for portfolio management. You have Keras and TensorFlow, which are deep learning libraries. You have scikit-learn that you see here, which is essentially machine learning. And you have YFinance and NSEPy, which is used for downloading data via APIs. So YFinance is used for downloading data from finance.yahoo.com, and NSEPy is for downloading market data from NSE, right, in an automated way. So notice that this entire field of quant finance is so primarily is viscerally connected to data, right? It all begins with data, all of whatever we do, because of access as well as availability of data. So what do I mean by data? Well, as far as finance goes, I'd say there are broadly 4 types of data that we can talk about. The very first is market data. So this is what we see in on business news channels as well as in the newspapers, where we are tracking the prices of equities and options and what have you, right? So this essentially has price, volume, open interest, that kind of information. which we can get. We can pretty easily get it at daily level, right? So we can download data for the last 300 days, 500 days, 5,000 days quite easily. And it's also available at higher frequencies, like data that can be seen every hour, the way prices change, or in fact every 15 minutes, every 10 minutes, every minute, and so on, right? So market data is one type of data set that's available to us. The daily kind of stuff is you get pretty good quality daily data available free, but anything at a higher frequency, I'd say quality is slightly dodgy, but certainly data that comes via your broker is quite good. It's good quality stuff. And then there are many data vendors out there also who give you data, right? Where you can buy subscriptions and so on. Then you have another type of data, which is fundamental data. Now, this is the kind of data that typically is gets the accountants really interested, right? This is the stuff that comes from annual reports. So you have financial statements like the balance sheet, the income statement, the cash flow, and you have macroeconomic data like GDP numbers, inflation numbers, and so on. So the difference between market data and the fundamental data is that fundamental data typically comes annually or quarterly or every 6 months. So the frequency at which it's available is a little lesser. But you nevertheless also have analyst reports that you can, I guess, you can put in under the same category as fundamental data, but it's of a different nature, as we can see, right? You then have technical indicators, which I've classified as a type of data, and technical indicators are essentially coming from market data, right? So it's a function of prices and volumes. So all the price and volume data that gets generated for the markets are used to compute things like moving averages and RSI and Bollinger Bands and so on. So based on our investment style, based on our background knowledge and the things we are on, and in fact, even access to the kind of data that we have, we may prefer one or more of these types of data. And finally, by the way, the last kind of data set that I've referred to here is the alternative data space, which has gotten pretty hot, I would say, over the past few years, right? This is unstructured kind of data, right? This is the kind of stuff that comes in news, where we are trying to gauge the sentiment when we read an article about a firm or about an industry or about an economy. You also have things like sentiments that can be gauged from the tweets that go out on a certain event or on a certain firm and so on. And you have many other kinds of pretty out there data, right? You have satellite imagery, which is also used in order to get a sense of how a firm is performing. So there are data sets which monitor satellites, which monitor the number of empty parking spaces available in, say, like a big box retailer like a Walmart, right? So if parking lots are full, it means that there are many consumers at a Walmart, and one can kind of get a leading indicator on how sales for Walmart might look, right? So like I said, the fact that we have drones and we have satellites, that kind of images are also these days used in order to get an edge over other participants in the market. All right, so now I think it's a good time for us to jump into the notebook. All right, so let's start with what we would typically do in the case of when we start working with financial market data, right? So the first thing we typically do is we import a set of libraries. So I had referred to a certain set of libraries a little while back. So you do things like this: import NumPy as NP, import pandas as PD. So now, as I mentioned earlier, these libraries are used for processing the data. So NumPy is used for computation. Pandas is used for handling financial market data. So it kind of structures your data in the form of tables, which look like spreadsheets, but are a lot more powerful. And you have things like matplotlib, which is used for charting. Y-Finance, as I had mentioned earlier, is used for downloading of data via Yahoo Finance. So this is like, when you look at a Python program, this is like pretty standard stuff. So for instance, now if I want to download, let's say, the data for NVIDIA Corporation. So NVIDIA manufactures these, you can say, chips graphics processing units, GPUs, which have become very popular these days. And it's quite an exciting company. It's largely a hardware company, networking and I think chips. That's what they typically work with. So if you want to download it, so we could use say yf.download. If you were to do that, you can specify the ticker that we want. So in case of NVIDIA, it's NVDA. We want to specify, say, the start date for when we want this data. So let's say we want it from 1st Jan 2018 up to, say, 27th of September. So if you were to run this, voila, it's done, right? So at this stage, we've got our data. And if you want to see how this data looks, you'll see that we've got about 1450 rows starting from 2nd of Jan, where the price was around, the close price was around 49.8. The adjusted close also was around 49.3. And eventually on 26th of September, it was about 419 or so, right? Notice the information that we have here. We have the open, high, low, close, adjusted close, and volume, right? So this is very typical of financial market data, where we have this each day for the last 5-6 years, right? From start of 2018 until yesterday. Now, this is the way, we kind of fetch the data. So it saves us the time of going and downloading a file and opening it and all of that, right? Now, let's say you want some basic statistics of this. So there's a nifty little function called df. So firstly, df is the name we've given to this, what we call a data frame, which is the, like I said, it's kind of like Excel on steroids, the data frame itself. Sorry. And it's used for basically handling this data and adding columns and in general manipulating the data, because we are dealing with like many rows of this, right? All right, so let's start with something like a df.describe. If you want to run this, it gives you some details, right? It gives you the count, the mean, the standard deviation, the minimum value, and these give you the percentile values. So what is there at the 25th percentile, the 50th percentile, which is nothing but the median, the 75th percentile, and the max value, right? So for instance, if you were to look at, let's just look at the adjusted close column, right? For the sake of this session. So we have essentially 1443 number of values for adjusted close. The mean over this entire period was 143. Standard deviation was 105. The minimum was about 31. And these are the percentile values, and the max being about 493. Right? So this gives you some details. If you want to do like a sanity check on your data, you can do like a df.info. So this incidentally also tells you, by the way, that this is a pandas data frame. Notice that it says data frame here, which is what it's called, this particular data type. It's also got some details on the columns that you have, the data type that it has, and the number of non-null values that it contains. So when I say non-null, it means your data is not corrupted. So so a null value would mean that for that specific day, for that specific row, some data was lost, right? So here you can see that all of them are non-null. Float essentially tells you that these can have fractional numbers. So you could have values like, and we know this, right? With stock prices, you can have fractional parts. You could have prices like 483.75 and so on. However, volume is stored as an int, which is nothing but an integer. So these are numbers that don't take fractional values. So it gives you some kind of idea on how these prices go. Now that you've downloaded this data, you may also want to save it if you'd like to, right? So if I want to save it, all I need to do is I could say df dot to say CSV. So I want to save it as a CSV file. For those of us who don't know, CSV file is nothing but, I'd say it's like one of the flat data files that you have. It's comma separated values. So it kind of looks like a spreadsheet, but it's a lot less richer. So you don't have like columns with borders, and you don't have like certain values which are bold and so on. But nevertheless, it's a beautiful way to store the data because it can be shared across languages and across various systems. So CSV files are like I'd say a standard way to store data files. So I could, create, say, uh, a CSV file called NVIDIA. And if I say df2 CSV, and if I go to my working directory, here I have a file called NVIDIA, right? So if I double click on this, sorry, you can see that I have this entire data. Right? Okay. So this is like basically one way for us to download data as a CSV file for one specific stock, right? What if we want to work with multiple stock data? We want to work with multiple stocks. You can specify more stocks. So let me do one thing. Instead of typing this stuff, I was planning to type this stuff and walk you guys through it, but because of the paucity of time, I think I'm going to go to my after file. So I had an before and an after file, thinking we could walk through this stuff, but there's so much that I want to talk to you guys about that I think I should probably directly work with this. So I'd rather talk about what we are doing than start typing it, right? Okay. So now if you want to work with multiple stock data, you can specify, say, start. You can create variables like start date and end date. So we've created that here. And when we do the download, we specify all of the stocks that we want within these square brackets. So for instance, here I want NVIDIA. I want the firm Visa, whose ticker symbol is V. Then there's Caterpillar, which is a construction machinery firm. And PEP is Pepsi Cola. So if I want to download all of this stuff, I can do that. Okay, firstly I need to define it. Let's do this. So we'll import all the libraries and we will download it here. Great. Beautiful. So now you have the data for what, like 8 or 9 years of 4 firms and all their details, right? You have adjusted close, high, low, open, all of this stuff for all of these firms, right? So if you do like a dot head, you get those details. And if you do the first few rows, and if you do a dot tail, you get the last few rows, right? Now, suppose I just want to pull out the adjusted close prices because I want to work with that. I can create another data frame called adjusted close where I pull out the adjusted close prices. So now all the prices I have are for CAT, NVIDIA, Pepsi, and Visa, right? So I have all these details. Notice that I have about 2,200 rows of data. Right? So because it's over 8-9 years, again, I can do something like a describe, which we saw earlier. Now, suppose I want to plot this stuff, right? This is, I would say, like, whenever we start with quant analysis, we like to view, I would say, graphically look at our data because it starts telling us certain things and it starts giving us certain insights, which is hard to see when you just look at tables of numbers, right? So let's do that. Let's plot it. So here we've now plotted all 4 firms and their prices. Notice what we've done here. When we say dot plot, we specify that we want a grid, we specify the width of the line, and we specify the size of the figure that we want, right? So you have all 4 of them here, and it's kind of hard to compare because all of them have different starting points, right? Because obviously the prices of these 4 stocks, if you look at even like the data here, CAT started around $71, NVIDIA started around $5, Pepsi started around 73, and Visa started around 62, and eventually they are at these levels 272, 425, and so on. So since their starting points and ending points are so vastly different, it's a little harder to see what's actually going on when you want to compare the 4 of them, right? So if you want to compare the four of them, one thing to do is why not make the starting point kind of common, right? So what we can then do is we can uh, equalize the first number to be 1 for all of them, and every other number is proportionately changing with respect to that particular stock, right? So we take all of these prices. Basically, what we do is, let's look at this. We take each of these. So let's talk about CAT. So every number in this column is being divided by 71.86. So the first number then becomes 1. This would then be 68 divided by 71. This would be 67 divided by 71, and so on. Similarly, for NVIDIA, each number is going to be divided by the very first one. So 4.83 divided by 4.83, 4.75 divided by 4.83, and so on. Same thing for Pepsi, same thing for Visa. So that way, the first number for all of them would be 1, and everything else would proportionately change, right? So we do that here. And so this looks quite nice. Your starting points are the same. So it's kind of like, a race, and we want to see what happens at the end of the race, right? In terms of how they did over these 8-9 years. So now that we know this works, let's create a data frame called common start data frame. And instead of keeping it as 1, let's say that all of them were at the price $100 at the start of 2015, and we want to know that if, or rephrase that, let's say I had invested $100 on each of these firms on 2nd of Jan 2015, where would I be on 27th of September 2023? If I want the answer to that question, this should get me closer to that answer, right? So a $100 investment in CAT would have gotten me to say 379. $100 on NVIDIA would have made me a millionaire, right? I would have been nearly at $9,000. For Pepsi, it would have been at 230, and for Visa, it would have been at about 370. We can do a plot of this. When you look at a plot like this, you get a better picture of what's happening. Now, clearly, NVIDIA is like the breakout star, right? It's done phenomenally well compared to the other three. But since that makes it harder for us to compare these three guys, we can only plot these three guys to at least get a sense of what's going on there, right? So notice what we are doing here. We are now specifying that, okay, I want to just look at CAT, PEP, and V. Right? So I run that. Notice again, when I say dot plot, I have a grid, I have line width, I have fixed size. I run it, and gives me an idea of what's happening with these three guys, right? So it appears like Visa and CAT, if I had invested $100, would have gotten me somewhere near 375 or so, right? And comparatively, Pepsi hasn't done all that well, right, over those 8-9 years. So this is, again, some interesting analysis of, say, analyzing a group of stocks, right? We may want to drill down a little deeper on one specific stock. So let's say I want to do it with NVIDIA. Let's just work with the adjusted close column. Oh, I forgot to run the first few sets. Let me run that. DF. Okay, DF is defined. So let's go back down because the error said DF wasn't defined. Where are we? Okay, so now we should be good. All right, so now we have another data frame called NVDA, NVIDIA, and with just the adjusted close prices. So I want to create a column with the returns that you get if you so a column called returns, where essentially what I'm doing is I want to know what the daily returns on, say, NVIDIA would have been. So when I say daily returns, I mean I buy at 49 and I sell at 52, right? So that would mean the return on, say, 3rd of Jan 2018. Similarly, I buy at 52.5 and sell at 52.8, right? Now this can be easily done with a function called percentage change, which I run here. I run that and I check. So now I have a new column, right, called returns, that gives me the daily returns for the entire column of nearly, we have like nearly 1500 rows of data. It calculates all of that. I have one NA or not a number here. So I drop that specific row to make things a little easier. And now I want to check and see the distribution of how my returns look over this period, right? So if you want to check for things like distribution, a histogram is a good place to start. So we essentially plot a histogram where we specify the number of bins we want, right? So we can even specify something like 10, but 10 is a little too coarse. So if you want a, a higher resolution image, you should probably do like 100. It gives you a nicer shape, gives you an idea that returns in general seem to be around 0%, right? Daily returns, with most returns being just a little over zero, right? So we can make that 100, even 1,000. Okay, 1,000 is too fine. So I think 100's better. So this gives you an idea of the histogram. You can also get a density plot, right? So a probability density plot where you do like something like a dot plot and you specify that you want a density plot this time. So it gives you a different, I'd say, view of the same data, right? So it gives you, so this is essentially like plotting a curve around this, right? So what our eyes were doing implicitly is being done explicitly here when you get a density plot going, right? Okay. So we've spent some time now on looking at single stock, multi-stock, and doing some preliminary data analysis, right? So now what I want to do is I want to go and jump into a strategy in terms of what you can do using Python to run a strategy, right? So we are going to use a very simple strategy. It's called a moving average crossover. So here what we'll do is we are going to compute these moving averages. So you compute the average price of a stock over, say, the last few days, right? In our case, we are going to look at computing the price over, say, 45 days or over, say, 90 days. And every time the short moving average uh, crosses the longer moving average, we are going to buy. The polarity is exactly the opposite. We are going to go short. That is, we are going to sell, right? Uh, Now, this is a pretty, I'd say, standard strategy that is used in the markets. It's referred to as the hello world of quant strategies because this is one of the first things that people start experimenting with when they want to start working with systematic trading or quant trading, right? So we are going to do that here. So we create two variables. It's called S, shorter look back period, and longer look back period, referring to 45 days and 90 days. And we compute the rolling means or the moving averages. So computing moving averages is done via the rolling mean function in Python and Pandas. So that's what we've done here. We're computing them. And then we want to plot them all to see how they look, right? So what you see on your screen here is the price of NVIDIA over these last 5-6 years. And these orange and green lines, which show you the shorter look back and the longer look back, right? So what we want to do is every time these lines cross, we want to take a position, right? We want to go either long or we want to go short. So really speaking, the times when we do it is going to be, say, here, it's going to happen around here, it's going to happen around here, and so on, right? Wherever you see these crosses is where we are going to start taking positions. And like I mentioned earlier, the position we take is either we go long or we go short, right? So when I say go long, it means we are buying the asset. And when I say go short, it means we sell the asset, right? This is not the same as selling something we own. It is selling before we buy, right? It's a specific concept that happens in the markets. You can look it up, online and see what the meaning of short selling is, where you are essentially reversing the order in which a buy and a sell happens. So rather than buying first and selling later, you sell first and then you buy back what you sold, right? Okay. So what we do here is we create a column called position where we denote one for going long, that is buying, and we denote going short or selling as -1, right? So if the shorter look back is greater than longer look back, we are going to encode that as 1. Else, we are going to encode it as -1. So that's what we do here. We drop the NAs to make our life a little easier. And when we now take a look at the data frame, you'll see all these new columns that we've created, right? The shorter look back, the longer look back, as well as the positions vector that we've created. Now, at this stage, it would be interesting to plot all of these together to see what's going on, right? So what we are doing here is we are plotting the adjusted close, the shorter look back, and the longer look back, which we had anyways done earlier, which is here. But additionally, we also want to plot the position column. And since the position column only takes +1 and -1, we will have a different y-axis for it. So you'll have a y-axis on the right side, which is going to track what's happening to the position, right? So let's do this plot. So when you look at this plot, notice that the left side, the left y-axis is for the prices, right? For adjusted close, shorter look back, longer look back. And the y-axis on the right is for monitoring what is happening with the +1s and -1s, right? So you can see that it was -1 for a little while in 2018. Then it was +1 for like what appears to be about a year. Then it was -1 again, +1 again, -1 again, and so on, right? That's what is happening. So in terms of the positions we took over the years, right? Now, at this stage, if you want to compute the returns of what your strategy would have given you, as opposed to a passive investment strategy where you just bought the NVIDIA stock, say in 2018, and you were sitting pretty, right? So this is what we call a passive investment approach, where we just buy a stock and we hold on to it. We call it buy and hold, right? So we create a column called buy and hold returns, BNH_returns, and we compute the log returns. So it's taken by computing the log price of today's. So today's price divided by yesterday's price, we take the log of that, right, to compute the returns. And for the strategy returns, we need to essentially take these buy and hold and multiply it by the position vector, right? So the position takes care of the fact that we it tells us when we are. It will multiply the right number based on whether it's +1 or -1, because we may be either long or short, right? So these two new columns are giving you the returns of the buy and hold as well as the strategy, right? So over the years, what is happening is, as time rolls by, what you can see here is that the blue line gives you buy and hold. So you started off here, and then you make a little bit of returns, and there was a period when you notionally were below 50% of what you had invested, right? The returns were really low because the firm did go through some really rough times if you invested around here. And then around 2020 it picked up, and then since then it's kind of had a really good run, right, until say about 22, and it went down again, and then it's again been going up, right? That's what a buy and hold has essentially done. Whereas your strategy in some sense has managed to go over this period quite well, right? So you managed to take the right kind of positions when the firm went through some really rough times, because those moving averages seem to have worked out well. Around here, the strategy has actually cost you a little bit, right? So the firm seemed to be doing well, but the strategy has gotten you take positions where you've made lesser returns than you otherwise would have. But nevertheless, you've still been on the positive side more than the negative side. I mean, overall, you've still made money. And again, this period, strategy seems to have done well, right? So overall, it looks like the strategy has done better than a buy and hold, right? So when we do take positions in a strategy, that is the least we expect, right? Because we are investing our time, our effort to craft a strategy, and at the very least, we hope that it does better than a passive investment strategy, right? I'm not saying this is the only way to measure the performance of a strategy, but this is, I'd say, like one of the first steps we do in order to evaluate whether a strategy is doing well or not, comparing it to a buy and hold. Okay, so again, we can just do a DF. to take a look at all the new columns we've created. So we've created all of this stuff. If you want to check what the actual returns were over this period, this tells you that the buy and hold would have fetched you returns. And by the way, these are log returns, right? They are not the typical numbers that we're used to, the kind of returns that we read in our investment books and investment return portfolios that our money managers may be giving us. So if you want to get a hold of that number, you need to kind of exponentiate these numbers to get that value, right? So which is what we've done here. So if you want to know how much would an initial capital of $100 from day one accrue to at the end of this time period, if you want to compare, say, a buy and hold with a strategy returns, what you should do is you kind of exponentiate this number, and we multiply it by 100 because we want to compare it to $100. We want to take a round figure. So if you were to run this, what it essentially tells you is $100 investment in NVIDIA back then would mean you're sitting on a pretty sum of $660 today. And if you had followed through with your strategy, you would have made like more than $1,000, right? So your strategy has clearly outperformed the buy and hold approach. So this entire thing that we went through now is to give you like a glimpse of what backtesting looks like when we start working with historical data and we want to kind of see what would have happened if I had taken those positions based on certain rules that I created, right? So as the name suggests, backtesting means we want to go back in time to see what would have happened, right? So I would say this is like one of the initial steps when we work with strategies and start doing our analysis. At this stage, I'm going to take you guys to Blueshift, which is, let me do one thing before I go to Blueshift. Let me open the Blueshift documents page, which should tell you what it is all about, right? So Blueshift is another product that we have at QuantInsti, which is a platform where you can both research as well as trade investment strategies. And this is where you use Python to do any kind of strategies that you want to work on. So you use it both to try stuff out, and in case your experiments turn out to be interesting and they seem to show some promise, you can take it live into the markets, right? So what I have done here is I have, for the sake of this lecture, I was playing around with some stuff. I want to show you guys what we've done here, right? So here what we have done is we are taking a Bollinger Band strategy from where we want to work with the New York Stock Exchange data, where this is a long short strategy using based on Bollinger Bands and SMA dual signals. So that is what this strategy essentially does. Whatever I now talk about is less about the strategy and more about all of the analytics that we get once we run it. And I want to talk to you guys about how platforms such as Blueshift help you get a much more well-rounded picture of what your backtest results look like. It gives you a slightly more realistic picture than say what we do on our own workstations. And it also helps you take things live into the markets, right, based on the brokers and those kind of things. So let me first give you guys a little idea of what's happening here. So like the way we imported stuff, you'll notice that even here there are a bunch of imports that first happen. So let me show you what's happening. So you import some technical indicators like Bollinger Bands and EMA, which is exponential moving average. You import something called commission and slippage, which we try to account for. And then there are some Blueshift specific API calls like symbol, order target percent, set commission, and so on. Now, the first thing we want to do is we want to select a universe. We want to select a universe of securities that we want to consider when we launch our strategy, right? So in this case, I picked some really large firms from the US stock exchanges, both NASDAQ as well as NYSE. So we've got Adobe, which is a software firm. There's General Electric, Microsoft, NVIDIA, This is Meta, which is Facebook. This is Tesla. This is Visa, and this is another, I forget the name. It's I think a microchip manufacturing firm. So this becomes like our universe. What we are doing here is we want to work with 1 minute data, by the way, and we've set some thresholds, some SMA period, short, long, Bollinger Band period, and so on, right? Like I said, this part of what I'm covering with you guys is not so much about the strategy. It's more about what emerges when we run the strategy and run a bunch of back tests or decide to do some paper trading with the strategy. That is what I want to talk about, right? So if you go through all of this stuff, it defines certain strategy parameters. It defines certain variables to track signals and target portfolio. For the sake of this part, we've essentially set trading costs and slippage to be 0. You can obviously add some costs here based on how things work with your exchange, whichever part of the world you are in. And then there are certain other functions like handle data, run strategy, and so on. Now, I know this program might look a little daunting, but the good news is that with regard to Blueshift, we have this GitHub page which has got a lot of sample strategies, and you can take a sample strategy, paste it in the core editor here, and make very minor modifications to try stuff out, right? So you don't have to start with a blank, canvas. You have, like, I would say, quite a bit of starter code which you can use in order to take it as a base and then make changes to it when you're working with something, right? So anyway, so with respect to this, so if I were to say that, okay, I want to run it on US equities, so we'll be essentially working with US equities, minute level data, and say, since it's minute level data, I want to work with, say, about 3 to 4 months. So let's start on 1st of June till, you can say, 27 September, and let's presume that I'm working with a capital of 10,000. So I say run. So one of the things that this particular strategy does is so it's trying to allocate the same amount of capital to each of my securities, right? So I have 1, 2, 3, 4, 5, 6, 7, 8. And since I have 8 securities, I would not want to invest more than 1/8 of $10,000 on any of them, right? So this is like an equally weighted approach to creating a portfolio. Obviously, one can choose many different approaches. We can we can do some position sizing based on how our stocks are performing, and that's again something which is slightly outside the scope of what we want to talk about for today. Interestingly, here what we are doing is, while we run this back testing, it's giving you, it's telling you what the results are telling you, right? In terms of what would have happened if I had followed through on these rules, say from June to September. So that's like 3 or 4 months, right? So it's giving you an idea of how the benchmark performed and how your portfolio is performing. So let this run. And while this runs, I'm going to click on go live. We'll come back to the screen in a bit, but I'm clicking on go live for now, which will show you what happens if I want to take this live, right? So I run my backtest. Let's say I like how things look. What I then do is I click on go live. So it says you want to make it compatible for a live run on Blueshift. So it gives you some things that things are happening. So let's just click on accept and execute. At this stage, it says go to settings. Settings gives you some ideas on risk management. So it tells you that do you want to set certain limits on how low your capital can go. So if it goes, let's say, below 50% your capital, you want to terminate the strategy, the algorithm. It tells you how many maximum number of orders that you can send. It tells you the size and so on, right? So I'm just going to stick to the default values and say save and close. So right now, essentially what I'm trying to do is I'm trying to do paper trading. That is, I don't want to put actual money, but I want to, based on how promising or how my backtest results look, I now want to paper trade. That is to say, I don't deploy real money, but I decide to take positions and see what would have happened if those positions had been realized, right? I could observe it for a few days, a few weeks, as per my wish. So I'll say continue. Here I'm going to select broker. So I have a paper trading account with Alpaca. It's one of the US brokers. So I'll say select broker. I'll say that I want to run it between say today and tomorrow. I could specify a capital of say 25,000. Continue. It gives me an option of auto confirmation. So I say auto execution, or it says one click, where at the very end, the user needs to click on whether you want to go live or not. So I'm going to go for auto, accept terms and conditions. So I will just go and say I accept. Then says review all information. So I say review. So this is my strategy. I have an account with Alpaca. Auto execution, capital, risk settings, all of this looks okay. Just selected default. I confirm. And this is how it begins, right? So it gives me some details on what's happening. It says creating necessary resources for the algo execution. So this is like the console, which gives you an idea of what's going on. So I could take a look at trades to see if any positions have been taken. I can go back to the dashboard. I can go to the code. So any of these things I could do at any stage, right? I can also stop my algorithm at any stage I want. Right? Now, since I have been doing this before, I was also running some other stuff before this lecture, we can even go and take a look at other things that I've been running before this lecture. So that should give us a little more idea. So let me look at something I started yesterday. So even this is running. If I were to go and click on trades, it tells me that on 27th of September at 11, there was a buy order for Adobe, but this order didn't get filled, right? This Adobe order got filled. So I placed an order for placed a request for to buy 4, but only 1 got filled. Here I wanted to buy 4 and all 4 got filled. So it says complete and so on, right? So this is for Adobe, this is for shop. So different stocks, and it gives me a picture on what happened in the previous day, right? So in general, it gives you, so what I'm showing you is we started off with backtesting, and then we are now doing paper trading to observe for how many ever days we want, right? So, okay. So let's go back to what we see here. So it tells me that if I were to have run this strategy from 1st of June till 27th of September, I would have got returns of 5.43%. So this gives me like a quick description of all the things that could have happened. If I want like a detailed description, I need to go and click on new backtest and get all those details. Since I've already run it in the past, I'm going to show you guys directly what happens when you run something like the new backtest, right? I mean, detailed backtest. So previously, previous to this, when I'd run it from 1st of May till 26th of September, and it tells me what the performance metrics of my strategy are. So it gives me annual returns, cumulative returns, and all of this stuff, right? In terms of how it has done, it gives me things like Sharpe ratio, which is like risk-adjusted returns. It gives me details on drawdown. There's also a tear sheet where you can look at different things like even a histogram of returns, the heat map of returns, and what positions we took on each of those stocks, right? You have some details on per trade metrics. So you have what happened on the short trades, what happened on the long trades, and so on, right? You have actual transactions that took place. So you have things like, okay, 6 quantity of Adobe was bought on, say, 1st of May. This is a back test, right? Remember, this is a back test. On 1st of May at 9:35, we bought 6 stocks for at a price of say 374. And then GE, we bought like 23 at a price of 100 and so on, right? It gives you all these details. It gives you also ideas of round trips. So round trip is both a buy and a sell for a given stock. So for instance, here you bought at 374.9 and you sold at 374.17. So your loss was minus 4.44 and so on. Right? So it gives you all these details. What basically Blueshift does, right? Okay. So I think now is a good time for us to go back to one last slide that I want to show you guys before I'm going to open this up for Q&A. All right. So I've thrown a lot at you guys in the last 1 hour or so, right? So specific to writing a trading algorithm, right? Let's see what we have done so far, and let's see how we can relate it to the chart that you see on your screens here, right? So as you can see, it all starts with data, right? Based on our backgrounds, based on the kind of access we have, we will work with the data sets that we can lay our hands on, right? And that is going to help us determine what universe we want to work. When I say universe, it means that you're going to have a universe of assets that you want to work with based on your preferences, right? So some people have a preference for blue chip firms, right? Firms that are listed, say, on the S&P 500 or say the NSE 50 stocks, right? The best 50 stocks or the top largest 50 firms that trade in your country. So you don't want to go beyond that. There are some people who have a preference for, say, mid-sized firms, right? Or so people may have a preference for a certain sector, firms of a certain sector, right? Maybe tech firms or finance firms or automobile firms. So basically, you decide on your universe from there. So here there are two things one has to consider. One is like the asset class that you like. So maybe you like equities, maybe you like bonds, maybe you like commodities, currencies. That is one part. And then there is the instruments related to the universe that you're interested in, right? So you could work directly in the cash markets, that is pure equities. You could be interested in futures contracts. You could be interested in options contracts, right? So you could, it would be a combination of these things, right? It would be equity futures. It could be equity in the cash markets. So that is common equity I'm referring to. It could be options related to equities you like, and so on, right? So you have these combinations. That essentially determines your universe. So once you have, you looked at your data sets, once you kind of zeroed in on your universe, then comes the trading idea. Right? So for instance, today we were looking at a moving average crossover. Now, trading ideas could come from a multitude of places. It could come from some news article that you came across in the newspaper or on a website or on YouTube or someplace, right? It could come from trader forums. It could come from just pure gut instinct, right? Maybe your gut instinct tells you that whenever you subscribe to an initial public offering, you will make higher than risk adjusted returns, right? So essentially what you're saying is that I should invest in any IPO offering that comes out, right? So you may want to go and test it, right? Again, when you say I want to invest in an IPO, do you then mean to say that you want to directly invest in the common equity of that particular firm, or around the time of the IPO you want to look at other instruments related to that firm, maybe the bonds that exist out there, right? Publicly traded bonds of that specific say, firm. You also have academic studies which could give you certain ideas in terms of what you could potentially implement in the markets. Now, once you have your trading idea, since we are all budding quant traders, we want to formulate entry and exit rules, right? We want to try to make it rule based, right? You want to create certain conditions which will allow you to enter and certain conditions which allow you to exit your positions. I would say the next layer of sophistication you may want to add to your entry exit would be to create rules for take profit and stop loss, right? So that is also good risk management practices. It's also good ways to preserve your capital, right? Once you have all that in place, you would want to program it, right? You may want to program it in say Python. You may want to program it in Pine script. If you like to use say something like a trading view, you may want to use even like a C or a C++ based on your background, right? So you use a programming language here. And then you want to backtest whatever you've done on historical data to see how it would have performed if you had followed through on the rules that you created previously. Based on the performance that you get on your historical data, so whether the results look promising or not, you decide to then paper trade some of those strategies. So understand this, guys, when you start working with trading algorithms, right? It's kind of like you start with say 10 or 15, and then as you go from step to step, a few of them are going to drop by the wayside. And eventually, the ones that come to the stage of paper trading have gone through multiple filters, right? Where the results have looked good, and only those results that have looked good or look promising are going to go to the stage of paper trading, right? So then you go and paper trade your stuff, and even there, if the results look good, then that's when you go and take it live. Right? That's essentially how your entire flow of, I would say, algo trading goes. Uh, right from uh, starting with data, eventually about and eventually taking it live. All right, great. So I think that's pretty much it in terms of the things I wanted to cover with you guys. So now what I'm going to do is I am going to
Thank you so much, Vivek, for this wonderful first
yeah.
presentation. And before we start with our second presentation, where we are going to dive deeper into the aspects of machine learning and large language models and their applications and implementation in trading, uh, so we will have a short Q&A session where we have received tons of questions, by the way. So we'll try to pick some of the interesting questions which Vivek will address from this presentation. And shortly after that, we will start off with the second presentation. We'll further deep dive into the more technical aspects of trading where we apply machine learning and large language models. And meanwhile, I have highlighted some of the questions for you, Vivek, so you can check them out in the questions panel and start shortlisting those questions. And I'll quickly cover about the 13th anniversary offers that we have. Meanwhile, Vivek is looking the questions. So as you can see in your screen, so we are celebrating our 13th anniversary this week. And with our 13th anniversary, uh, we are excited to present you with some exceptional offers that are only active for next 24 hours. Right. For this anniversary, we have this offer which is going to go for a week or so time, but just for the attendees of this webinar or workshop, they are going to get this exclusive offer where um, executive program in algorithmic trading. So you will be able to get 18% instead of 13% anniversary discount for the batch that is starting in October 8. So I have shared the link in the chat, so you can inquire for that. Then in Quantra, we are offering additional 7% discount to today's workshop attendees on top of 75% anniversary discount which is going to be there for this anniversary, and that I have also shared in the chat using the coupon code web75 plus 7. So make sure that you are utilizing that in case you have any preferences in the Contra courses. Then on top of that, if you are interested in learning Contra courses in a structured manner, so for that we have learning tracks, and on learning tracks we are offering additional 38% on top of current offer of anniversary, which is 75%. So you can also utilize that by applying coupon code web75 and 38. And with this offers highlighted, I think we can now move on to our quick Q&A session for this presentation. And yeah, Vivek, do you have any questions that you want to answer? Have you shortlisted any?
Yes, yes. So I'm going to start looking at answering a few of the questions that have come. So there are like really a lot of questions, guys. So in case I'm not able to answer them, please write into us. I will, or someone from my team is certainly going to take a look at it, right?
Yeah, in fact, I want to also highlight, like I have seen some of you requesting for Python notebooks and Jupyter notebooks here. So the thing is, see, there is certain interest which is I can see in the comment section. But let's say if you are going to, if you really want to get access to those files, please make sure that at the end of survey, at the end of this workshop, you'll get a survey. So mention that you want to get access to that. So if we have enough number of people asking for these files, we'll be happy to upload them online and then share links with all of you over email. So please make sure that you highlight those things in the survey that you receive at the end. So we'll take care of that. Yeah, sorry, Vivek.
Yep. Okay, so Philip asks, what's your opinion of using PyCharm and data lore? Philip, I'm not familiar with data lore, never used it. I've used PyCharm. Personally, I am very fond of VS Code. Uh, PyCharm is also quite nice, but like I said, I do like Visual Studio a lot. What about Vishwas asks, what about real-time data? Why finance does not provide it? Yes, you're right, Vishwas, it does not. For real-time stuff, I think brokers is where you should go. They are, I would say, your best bet when it comes to that. There's also, of course, your exchanges themselves. Sometimes, although on exchange websites, the data could be a few minutes delayed. Okay, I'm scrolling. Okay, Jin Yao Tai asks, for fundamentals data, can we retrieve using Yao API, or is there any other method to get this directly? Interesting question. Yahoo does not give you direct fundamentals data as far as I know. There are other places where you get it. Like for instance, Words is a pretty good place, but Word subscriptions, WRDS, I'm referring to, I think it's called Wharton Research Data Services. I'm not sure about the full form, but they have pretty good quality. I had used it a lot back when I was a research scholar in a university. I'm not sure whether it's convenient for people in the industry to use. There are other data vendors. I'll talk separately about data vendors and data itself because somebody else has also asked a similar question when I get there. All right. Okay. Krishna Chaitanya asks, what exactly are we going to get at the end of the day after the webinar? So Krishna Chaitanya, what I hope you will get is you should get a pretty good picture on what it takes to create quant strategies. Firstly, you'll understand what algo trading is. Then you'll get a sense of what it is, what it takes when you do something like quant analysis, how you go about evaluating, creating as well as evaluating a trading strategy, and what are the steps you need to follow to eventually take it live. So that is what I hope you will get. Let me also add, Krishna, that whatever you do, eventually you will need to spend time yourself with all of these tools and techniques, right? So there is only so much that instructors can do. What instructors hope to do in sessions like these is firstly to give you a, a a fairly good picture on what can be done and how things are done, and hopefully it kind of ignites a certain amount of curiosity in you for you to then eventually go and explore it yourself. Okay, I'm scrolling. Okay, Thukozani Mapanza asks, I hope I pronounced your name right, Thukozani. I have a question based on moving average. How do you calculate the number of crosses of a moving average? So this is slightly outside the scope of what we want to talk about, Thukozani. You can probably write into us. So his question is getting into the details of how you formulate or come up with whether in terms of creating the strategy, and he's referring to a specific strategy. So since it's slightly outside of the scope of what we are talking about, I'm going to let that pass. Okay, Swetang Chowda asks, from where can we gather data? Is data freely available? Is data that is freely available also reliable? Interesting question. There are a lot of different places where you can get data. Kshitij, I think we have a course on Quantra on data sources. You can share the link of that with our participants. Is freely
Sure, I will
available
do.
data? Yeah. So is freely available data reliable? I would say that's a qualified yes. So sometimes it is. In some cases, it's a little dodgy. I would say that freely available data is good for preliminary analysis, but eventually when you are getting closer to taking something live or you want to deploy it in the markets, you should be looking at higher quality data that you work with. Okay, I can see that a few people have said why take examples from NSE stocks. So since we have such a global audience, I chose to pick stocks from the US. If And when we do sessions for our Indian audiences, for sure, we will be talking about NSE and BSE stocks. Okay, Suresh Galsasi asks, data received from Yahoo Finance is for daily frequency. Where do we get data for granular frequency? So with Y Finance, interestingly, you can get granular frequency even from Yahoo Finance. You need to specify the frequency at which you want the data. So you can pick even 1 minute data that you get from Yahoo Finance. I think they have a restriction of data available, such higher frequency data only available for the latest 2 months, I think, 2 months or 50 days or some such. So you might want to check the documentation of Y Finance out if you're looking for that. In general, as I've said before, when you look for things which are non-daily data, I think brokers are a good place to get it. Rishikesh asks, can we get what information can you get from Y Finance? So the thing is, once you get the OHLCV data, that is open, high, low, close volume, uh, there are a lot of things you can calculate directly from there. So you can also calculate things like market cap. So I don't think you can directly get market cap from Yahoo Finance. You might want to check it out though. You'll have to check the documentation to see if it's available. I have never downloaded it directly from there. Okay. Maxim asks, can we load the data of crypto like I did with NVIDIA? Interesting question. I have never done it with Y Finance. You can check it out. I've never looked up whether Yahoo Finance has it, but there are many websites that do have that data. There is I think an exchange called BitBNS who have a lot of crypto data. It's a firm based out of India. So I think there you get a lot of it. I'm pretty sure there must be other places where you get crypto data. Okay, Lai Jinkai asks, is there a library to download real-time continuous data for trading on smaller trading frequencies? Yeah, so look, whenever you go for higher frequency stuff, right, things start getting a little tricky. So I don't think there's any place that I know where you can get it easily, which is free. Like I said before, if you go for paid data vendors, you can get reasonable quality. Your first port of call should be your broker. So Pritam Rituraj, sorry, asks, what if you want to use larger time frames, say for more than 20 years? I've seen Yahoo Finance doesn't support that. So I have downloaded, I think, even 30, 40 years of data from Yahoo Finance, Pritam. I think I had once downloaded nearly data from the 80s till 2023 for, I think, one of these indices from Y Finance. I'm not sure what you mean by that. Daily data, at least, I think, should be available. I don't see that as a big problem. Manem Yugandhar asks, will you share the code and the notebook and the data sets? I will be sharing the code and the notebook. I think as Kshitij had mentioned earlier, we will share it based on how many people show the interest. If a lot of you guys are interested, we will share it. That is what we usually do in these sessions. It depends on the interest level of our audiences. Okay, Tram Guyen asks, is there a way to combine technical indicators and fundamental analysis into one model? Again, very interesting question. Yes, there are ways by which you can do it. I would say it's like a mix and match thing, Tram. These days, what happens is if you have all the data that you need, you can be quite imaginative in the way you combine them to create sources of alpha, right? So I've seen people do some pretty crazy stuff by combining things, and it does create some interesting signals which can be eventually used. Okay, Biswajit Haldar asks, how to respond when the pop-up shows possible data loss while saving the .csv file? I'm not quite sure what you mean by possible data. Okay, so okay, again, I thought I understood it, but no, I'm not quite sure. Maybe you might want to rewrite that question, Biswajit. I'm not sure what that means. Okay, again, Onkarabil Mojapelo, I hope I got your name right, asks, does Yahoo Finance deal only with stocks or currency pairs also included? You'll have to check it. I have used it primarily for indices, a couple of exchange traded funds, and equities. These are the things for which I personally use it. So I'm not sure. Please check it. Okay, Daniel asks, can you explain why 14,9 for the figure size? No reason, Daniel, just for fun. You can play around with those numbers when you plot it. You make it big or small based on who you're sharing it with, and in case you're putting it on a presentation or something, you want to make sure it's visible to your audience, you tend to make it larger. That's all. Okay, Raman asks, normally indicators are lagging, means it's created after something happens. How is it going to help? So that's the thing, right, Raman? A lot of times these indicators are lagging, but still, interestingly, they still seem to have some value there. So people combine these lagging indicators to still help them get an idea of what's going to happen, in the future. And they've served us well, I'd say. One has to be careful, but you're right. You're absolutely right about the fact that you are using things like simple moving average to compute today's average based on all of the stuff that happened in the past. But that's just the way things go. Unfortunately, we have no reliable way to look at the future in any sphere of life, right? If only we could see the future as clearly as we could see the past, I think, as we say, right, hindsight is always 2020. I think lawyers would be out of business if we could see the future. There would be no need for them to be around. Any lawyers here? All right. Tushar asks, can we combine different strategies with specific price volume action? Absolutely. You can try all sorts of things out. Once you have the data set organized nicely in a data frame or any suitable data structure, you can try a lot of these things out and see how it goes. Okay, Cherish Patel says, can we do optimization in Blueshift like shorter MA 5 to 10, longer MA 20 to 50? Yes, you can do all of that. You can play around with all of that in terms of optimizing the MA, shorter window and longer window. I would warn you that, you might, if you get too involved in doing that, you might end up kind of overfitting your data. So the proof of the pudding is really in the eating. Whatever shorter and longer look back periods we have, we would want to see how it performs on unseen data, right? That is, like in our context, it would be something like paper trading, or if you're using, say, I would say like a machine learning mindset, we are talking about test data sets, right? Which is outside of wherever you trained your data on.
Thanks, Vivek. I think we are running out of time and it's time to start our second presentation. There are so many questions. Even I have shortlisted, there are many questions. So I would humbly request everyone to put these questions in the survey that you get at the end of the workshop, and we'll make sure that all of your questions are answered. There are so many interesting questions. I also shortlisted it and I can see I really want to answer them, get them answered by Vivek also, but we are short on time. So thank you, Vic, for such a wonderful presentation. And now we will start off with our second presentation. And for our second presentation, we have here with us Varun Pothula. So many of you who have attended our recent webinars know him already. And so Varun is a quantitative analyst and content and research team at Quantra by QuantInsti. And hey Varun, how are you? Can you hear us?
Yes, it is. Yes, it is. I can hear you.
Great. I'm going to make you the presenter so that you can share your screen.
Okay, that's great. So
And
can you see my screen?
yeah. I can see your screen. And before we start with your presentation, a quick introduction I'll do on my side. So a quick introduction to Varun. So Varun holds a master's degree in financial engineering, and he has experience working as a trader, global macro analyst, and also an algo trading strategist. he is currently working in the content and research team, as I said, and he has contributed to many of the recent courses, advanced courses, which were created by us and published on our Quantra portal. So yeah, with that said, Varun, the stage is yours.
Thanks for the intro, Sijit. Welcome everyone for the second part of the webinar. Yeah, and this is already been introduced by this already. But just to repeat, yeah, I have 8 years of experience in the market, and yeah, currently working as quantitative analyst at QuantInsti, where I create courses on machine learning options and etc. concepts for Quantra. So let's go through our agenda for the second session. So this is going to be a bit complicated than our previous session because it's a natural progression to that. Like who are algo traders, they would start thinking about, can I use machine learning for algo trading, or if I can, what are the ways and what are all the thought process I should build, or what are the intuitions or areas of intuitions I should focus on before getting into this. So this second session will answer all those questions. So we have planned this in this flow. First, we'll start about an overview on machine learning, and we'll also discuss on different approaches machine learning takes. And then we will see how we can use ML for algorithmic trading at an idea level. And then we will go for a little more practical orientation of the same idea that we discussed by going through an ML based trading model. And then we will discuss on LLMs, large language models, and how they are used in trading, or what are all the different ways people are using them in trading. And we will end the session with an interactive Q&A, just like we had for the first session. But before we move forward, I would request Sitish to launch the poll question so that I can understand the audience better.
Sure. So let me launch the first poll, and that is, how familiar are you with machine learning? Uh, so answers are no knowledge of or experience in machine learning, have knowledge of machine learning but never used for trading, have experience using machine learning for trading. So I would request everyone to share their answers. And so far, I can see now we are seeing a lot of answers. Yes. It's 50%, almost 60% now. We'll wait for 10 more seconds, and that's about it. So let me close the poll and share the results. So as we can see, we have a lot of people who are familiar with programming, but 48% of the audience is not, like, does not have experience in machine learning, and 44% have some knowledge of machine learning, but they never used in trading. And there's only 7% of the audience that has actually used machine learning for trading. So yeah, that is expected. And so almost half and half audience. So half of the audience is actually familiar with machine learning and half is not. So with that, I'll hide the results and we can resume the presentation.
Thank you, Siddharth, and thanks everyone for participating in this poll. So this poll helps me to set the pace of this webinar, or at least this part of the webinar. And yeah, let's move ahead. So let's start by understanding what is machine learning and why, like how it is used for algorithmic trading. So so you must have heard about the word AI, so which is widely used by everyone. But when it comes to machine learning, the first thing is machine learning is a subset of AI. So that you should know. So this is how AI, machine learning, deep learning, all these three terms are segregated. For example, artificial intelligence talks about everything. Basically, as a definition, this talks about the ability of machines to mimic or simulate or behave like humans, basically mimic the behavior of humans and take decisions like humans, or take intelligent decisions like humans. So that's the idea of artificial intelligence. And in artificial intelligence, machine learning is a part of artificial intelligence, where This is specific to machines where the ability of machines to automatically learn without coding them explicitly or without programming them explicitly. So generally, if we have to create any automated system without ML, we will just write for loop or like write conditions or true, not true, etc. Do this if this happens, don't do this if this happens. Like that, we will write some logical conditions. But what if the machine is able to learn things automatically according to the training it was given without explicitly programming the conditions or the decision to take? So that's the idea behind machine learning. And yeah, it's a part of AI. But when it comes to deep learning, it's again a part of machine learning where it's a special case where you use neural networks, just like our brains. That's where the term comes. But then we use artificial neural networks, where the program or the machine is able to learn by studying the environment, and its learning will be reinforced by the reward system. So we're going to discuss about this as we move forward in a couple of slides. But this is how AI, machine learning, and deep learning are connected. So to summarize, ML, we're going to focus on ML, application of ML in algo trading in this part. So ML is a subset of AI, and basically it learns from data. So that's what you should know. So ML learns from data, and once it learns, it makes predictions, and it will be able to take certain decisions. So this is the basic idea you should have when we are approaching ML, so that we can create our we can think properly. That's what it is. So we have to set our expectations right, and as we move forward also, we are going to discuss about the limitations as well whenever we approach anything or any problem with ML. So especially there are different ways you can approach to a problem using ML, or you can also say these are types of machine learning. So broadly, there are three types. The first one being supervised learning, and the second one is unsupervised learning, and the third one is reinforcement learning. So the definition lies in the name itself, but let's start by understanding supervised learning. So the major difference or the characteristics of supervised learning is, as we discussed, ML algorithms learn from data. Now the difference is what kind of data. So for supervised learning, you use labeled data sets. So basically, for example, let's think in terms of trading. Let's say I want to create an algorithm that would classify a stock whether it is a volatile or not. Let's say I want an algorithm to tell me whether a particular stock is volatile or not. For example, if you do manual analysis and you might, if I give you a test and ask you if that is a volatile stock, you might be able to say. But if I want my machine to tell that, or if I want my algorithm to tell that, in supervised learning technique, first I will label it. I would take 100 stocks, label them as volatile, non-volatile, volatile, non-volatile, etc., and give that data to my ML algorithm. So this is what happens in supervised learning approach. So generally, this is used for predictions whenever you are, or it's sometimes used for classification also, of course, but mostly it is used in trading because we have particular ways to analyze the stocks or scenarios in the market, and we would want our machine to replicate that. That's the first step of a quant. Like that's what a quant starts in applying machine learning. And in extension to that, we would also use unsupervised learning. Like, okay, let's say we don't want to label anything. We want to give entire data to the machine and let it figure out, let it divide into different parts or different types. So basically what we're doing was we use supervised learning technique where we don't label the data at all. We will let the machine figure out the patterns in the data and let it classify or cluster the data accordingly. So that's the reason in the unsupervised learning, we don't label the data at all, and we would let the system to figure out, or the algorithm to figure out the structure of the data, the patterns or relationship between different sets of the data, etc. And in general, we use it for clustering. So if you guys know about portfolio management, it's all about creating different types of stocks or taking different types of stocks and diversifying them using your capital. So that's the reason mostly like one major application of unsupervised learning in trading is in portfolio construction. So I'm just giving you basic ideas so that when we are going to a real problem or probably Python implementation, you would be able to know what are all the limitations of that particular method and what is the thought process that's going to help you to better understand that. And the last one being this is the most interesting one, reinforcement learning. So this is completely different from the other techniques. So this is a place where you hear these terms like state, action, reward, environment, etc. So basically, to give you an idea, this JF can give you an idea. So this is what happens in a reinforcement learning. And this robot kind of a thing you see is called an agent, or it's also called as RL agent or reinforcement learning agent. So this is like teaching a kid, okay, so teaching something or a machine or someone who has no idea of what the environment they are in, but they keep on doing certain actions and keep on learning. It's almost like if you're training a child, and if he is doing a good thing, you would reward him with a chocolate or something, and if he is doing a bad thing, you would probably punish him or give a negative reward, if I could use the term. So this agent learns to maximize the reward. For example, if I put it in an environment of trading, as you could see, it is taking certain decisions. For example, if you see on the left side, it has taken a buy position, and the current algorithm will give it certain reward. And when it takes a sell position, it would take another reward. So if it keep on doing these actions, for example, as a trader also, you do 2 actions, technically 3: buy, sell, and don't do anything, of course. But if we don't consider that, we have 2 actions to take: buy and sell. According to the state of the environment, the ML or this RL algorithm keep on taking buy and sell positions, and according to the reward, it will correct its decisions. So this is the whole idea about RL. But if you could think, this is a bit different from what happens in unsupervised learning or supervised learning. So these are the approaches of ML. But enough about these approaches. Let's see practically what happens. Like in general, if you have to create a trading algorithm, or if you have to use ML in the space of trading, what would be the workflow? So let's see how it is, and let's go into the Algo Trading with ML workflow. So this is not this is not a standard workflow, or I must say this is not the final workflow you might see in some hedge fund or any other problems hedge funds are trying to solve. But this is a generic workflow, and we're also going to see an example, a Python implementation of the same, and also create a strategy on the same. But this is the general workflow for any ML algorithm, especially in trading. Start with the data, because as we discussed, ML algorithms learns from data. So we start by collecting the data and then passing the data into the algorithm. So as a first step, you get the data. As Vivek also mentioned, there are different types of data. Yes, there is a price data, there is fundamental data, economic data, news data, social media data. Yeah, there are a number of data. There are again alternative data, so data types also, as Vivek mentioned. But yeah, in general, when you are starting to learn algorithmic trading or implementation of ML for algorithmic trading, you would start with price data. As you might have heard the term OHLC or OHLCV, which is open, high, low, close. You start with this data, which is the basic data or basic representation of what's happening in a market over the day. And even if you see candlesticks, you might have already seen candlestick charts, and this is the information you see on candlestick charts: open, high, low, close for each candle. Here is a daily data. So this is about the data. You start with the data, you collect the data, but that's not it. You need to pre-process the data as well, because yeah, you need to clean the data. First of all, you need to remove the unwanted observations. For example, I got data from somewhere, maybe Yahoo Finance, and it has got adjusted close. Let's say I don't want it. I would remove that unwanted observation, and I would also fix structural errors. For example, here we are using time series data, right? So when we are using time series data, the date should be in an order. It shouldn't be like the first row is about 2012 and the second row is about 2022. The structure should be right, especially when you really know the implementation or the problem that you are trying to encounter with ML. You'd be able to clearly define the structure of data you want and fix the data structure. And then, of course, you don't want any unwanted outliers. Like, first of all, when you are getting data from free sources like Yahoo Finance, you should always think about pre-processing. You should always plot it and see if there is any unusual behavior. Let's say suddenly there might be a 200% jump in a stock. It's an outlier. You have to question it and see, okay, did it really happen, or do I want that in my data? Because if there are certain outliers because of bad data, it's going to influence your ML algorithms training and eventually the return, eventually the predictions as well. So for that reason, you have to manage unwanted outliers, and also, of course, you should handle the missing data. So yeah, with these free data sources, or of course sometimes with premium data sources also, there might be missing data. You have to handle that. So these are all the primary things you do with pre-processing. There are other things also you might do, but as I said, this is a generic workflow. And now you have got the data and you clean the data. Let's say instead of saying pre-processing, let's keep it simple. Let's say you clean the data. Now the next step is feature engineering. Now it sounds like a technical term. Of course, it is a technical term, but let me make it intuitive to you. For example, let's say there is a student who wants to learn trading, and you are a trader, and you are a kind of a trader who uses technical indicators to trade. Like, so if a student comes to you and asks you, how can I do my analysis, how can I study a chart, you would start explaining about indicators, because of course, see, we have this data, open, high, low, close data. Only with this data we might not be able to say lot many things about the stock. For example, if you're talking about a stock, price is not the only thing. You have to talk about volume, and you have to talk about how price moves. That means the trend of a price, and you would also talk about the momentum of a trend, how fast the price is moving, and you would also talk about the volatility, how edgy the stock is, or you must say how difficult it is to define a trend, you would say. So these are all the things you would talk about, or you would analyze as an analyst for a stock before you come up with the idea of whether to buy or sell a stock. So here also you need to think that you have to train a machine, you have to train an algorithm. If I could use that word, you have to create an algorithm by training it. So it needs to know the language, and it needs to know the tools with which it can create its own model. So for that reason, we don't directly give our open high low data. Instead, we would create our features. You can easily start with technical indicators. You can use RSA, MACD, etc., and you can call them as features. So features are nothing but things you extract from your data so that it can be used for the model to learn and also to predict. For example, in our case, when I'm talking about feature engineering, first of all, you convert the raw data into features or attributes. So the one we have seen is a raw data, open high low data. So you first step in feature engineering is to convert it into features. There are actually different names. Somebody might call it as feature creation, because you're creating features from the raw data. And then there is another step called feature transformation, because if you think about it, for example, let's see the data, raw data we have OHLC data, which is pretty much around 120. Let's say if it is the other dollars, it's pretty much around $120, or yeah. Let's say we have volume data also, it would be in millions, like so there is a stark difference between the range of OHLC, open, high, low, close, and the volume. So we don't want to give the data which is not scaled. It's called scaling, where you want to get all the data into a single scale so that it's easy to analyze. For example, if you could recall the example given by Vivek, where we was trying to compare different stocks, but before that he made sure that every stock starts with 1, and then he was able to compare them, because he essentially brought every stock to a single scale so that it can compare. If one stock is starting from 100 and other is starting from 10,000, it's very difficult to compare. So that's the basic fundamental idea behind transformation. You would want to transform your data into a single scale so that machine can easily understand the patterns inside the data and also do the comparative study. And yes, feature extraction, yeah, again, feature creation, feature extraction, these are similar terms, but you could also say feature extraction and selection are the same, where if you have, let's say now we have 4 features, if you don't want to use those 4 features, and if you want to use only 2 features which you feel like which has more importance for the problem statement, yeah, you can do feature extraction or the selection. So these are all comes under feature engineering, where instead of using the raw data, you're creating an additional data or an extraction of a data from it. So this is how it looks like. This is the raw data we have, and once you do feature engineering, your data set can expand as well. For example, I'm going to explain you what these are. This is 3-day moving average, this is 15-day moving average, this is 60-day moving average. So these are all the things generally when you're trading as well, people have this tendency to see how the moving averages are, or especially whether my current price is above the moving average or below the moving average, or on an average what's happening in the market, what's happening today compared to what happened 3 years ago or 3 days ago, 15 months ago, etc., time frames. So they would use moving averages there. So when you're creating an ML model, why don't we also give these kind of features to the model and let it figure out? So the data you're taking as an input to your mind and analyzing the data, let us give the same data to ML model as well, and let's see what it comes up with. So with that thought process, several things were added. Yeah, this is just an example where moving averages, correlation is added, and also this is a standard deviation on the upside and down. These are different things that were created, but these are not limited to the ones that are listed here. It's about your understanding of the particular scenario you want to use your ML model in. And as I said, if you want to do, you're a manual analyst who uses a couple of technical indicators to decide whether to buy or sell a stock. If you want to use ML, create ML algorithms to replicate your thought process, you would want to use those features. If you're very clear about it, sometimes people might not know what are all the things that are impacting a stock. They might only analyze the momentum based indicators like RSI and MACD. They might not think about volatility. Yeah, that's a miss. If you're not analyzing volatility, you might not get complete idea only by analyzing momentum. But if you're so confident that you know what are all the things that impacting the stock, then you can list down the features and confidently create your feature rating set. And this is first three, you can think of these first three steps as the basic things you do for any kind of ML based approach. But the next one is data split. So we split the data. Ideally, this is something like this. If you are teaching a student and if you want to test the student at the end of semester, you wouldn't want to give him all the questions or all the information over the tutoring period. Probably 80% of the information or the questions you would give him before he attends the exam. And once he learns it, we would want to test him, right? That's the reason 20% of the questions you would give or the new concepts you might introduce to him in the exam to understand how he is thinking and what kind of decisions he is taking. So same thought process we do here. For that reason, we first split the data. So we would split the data. There are different ways, like different data splits that happens in an ML workflow. So the first one is dividing your data into input and output. For example, let us go to, let's just work with this raw data, or let's work with this raw data. For example, you were using open, high, low, close of the prices, and you wanted to predict the volatility. Let's just say that. So these are the input data. This is the data you give as input, and you're expecting volatility as output. So in that case, the input data set would be the data set you are giving as input, as we have seen open, high, low, close, and output data set would be the volatility. So I'm going to show you in code how these data sets are, but as of now, you need to understand that there are different different sections of data that goes across the ML workflow, and the first one is a division of input data set and output data set. So we kind of give the input data set to your model, and it's going to spill out predict the output data set. And now another data set would be train and test. This is similar to the example I gave as tutoring a student with only a limited information or 80% of the textbook at the beginning, and testing how he learns or how his decision making changed with the 20% of the textbook. So you divide your data into train and test. Using the training data, you train your model so that your model will learn, and then test how better the model learned or how well it's performing on the test data set. For that reason, we divide the data into test and train, or train and testing. Now this is what happens after this, and this is where the interesting stuff starts. So once you divide the data, you pass your training data into your ML model. There are different types of ML models. Here, this is a linear equation. So if you have a linear regression, if you want to do basic linear regression, the one you do on Excel or the one you do with your coding, if you want to do with the ML, you can also do with your linear regression model. And let's say I've just represented a model with an equation, but this is not the only equation, or this is not representation of a single model. There are more complicated models as well, but you're just giving an input data, and this X represents the input data. If you remember, input data is represented by X and output is by Y. So basically you're giving input data, and accordingly their output will be calculated. Since we have training data, let's say you give 3 years of data, by iteration it's going to figure out the parameters like this is a slope and this is an intercept. These kind of things will be trained, will be learned by the model or calculated by the model, and model will be decided, like model will be fit. That's what happens even if you're doing linear regression by hand. That's what you do. You try to use several rows of data and figure out the intercept and also the slope, and you would finalize m and y, slope and also the intercept for your linear regression. And later you would input a new data. Whenever a new data comes, you just need to input the new data X and you're going to get the Y. That's what happens when I say you train your model or model is learning. But there are more complicated models also. Here we just have y is equal to mx plus c format, and sometimes there would be some models which are which need to be tuned. For example, you might have models with so many variables, and you might have to initiate a model with certain variable. I'm not going into details, but ideally this is called optimization. There are certain parameters with which you need to initialize your model, and yeah, so there are different combinations of parameters. So first you need to decide what combination of parameter I want. So for that you do optimization. I'm not getting into details, but you would hear these terms called cross validation or grid search optimization, random search optimization, etc., etc. So all these terms comes in optimization of an ML model phase. As we move forward, I'm also going to give you, or probably at the end, I'm going to give you the resources at which you can learn all these things in detail. But as of now, this is the flow you need to keep in mind, where once the ML model is fit or model learns from the training data, then it is optimized, and then the test data will be passed. This is almost like you taught the student, he has learned everything. Now it is the time to test. So once initially you divided your data into train and test, machine is not exposed to your test data yet. This is the time where you input your test data and see how the predictions are. This is where you can also check accuracy, and you can also see the performance, etc. But I'm not going into that, but this is a general flow. You get a data, clean the data, convert the data into machine understandable set, and then divide the data first into train and test. On the train, you make the model learn, and on the test, you will see how the model uses. So for here, there is an example of prediction. There is, you can also classify, and you can also do n number of things, but yeah, this is a general flow. But this, with that flow in mind, let's see if you could do something. If you can see, if you can try to use this thought process, and in Python especially, and see if you can gain some insights into trading scenario. For example, let's see if you could predict the very next day's high and low. Generally, people would want to predict prices. If anybody who starts with ML would want to directly predict what happened, what is tomorrow's closing price. I don't think that's a good way to start, or that's a ideal way to use your ML model, because it's very difficult to predict the next day's close, because the close price is decided over the day, and also there are many factors that's going to define overnight. Also there are certain factors that's going to define where the stock price would go. But you can actually have a prediction on certain things like volatility. Instead of predicting the price, you can also predict volatility, and you can think, or you can model about volatility, and according to the predictions on volatility, you might take a position, be it in options or be it in stock itself. You can also think about the deviation, means if it opened at 100, how far it could go. I don't want to predict where it will land or where it would close. I just want to know, I want to use my ML algorithm to tell me, if a stock opened at 100 tomorrow, what could be its high and what could be its low, and if it is going up, how far it can go. If it is coming down, how far it could come down. I felt like this is an interesting question to ask the ML model, because once it does its predictions, how many things I can do. I can take certain decisions. If I'm predicting just the price, there is only one thing I could do. If it is going up, I can buy. If it is going down, I can sell. There is not much freedom for me, or there are not many decisions I could take once ML does its work. But if I formulate a problem like this, and I'm going to show you clearly. So let's say I want to use linear regression, and I want to use my ML model to predict high and low of the next day. And once it does its prediction, I would think about it and create a strategy. And I don't want to stop there. I want to backtest the strategy also and see how this works. So this is what I wanted to explain. Let's say the recent candle, the last candle, the green one is today's candle. And I don't want to predict where the stock would go. I don't want to say, I don't want everything. I don't want close, open, everything. I just want range. So this is a very big candle. Would tomorrow also be a big candle? You can also think in that way. I just want to know till what high it could go and till what low it could fall. And I would want to strategize based on the predictions also. Let's say my ML model predicted a certain high and low, this high and low for tomorrow. Now I want to create a strategy like this. Now, since my ML model said this is an extreme, the market could go on the upper side. In case if the market went above that, I would want to sell it, because I know my ML model was trained on different market phases, and in case if market went beyond that high, I would bet that it could correct it and come back over the days. With that assumption, or you could say hypothesis assumption or a hunch in mind, I can create a trading strategy like this, where an ML model will predict high and low, and over the day, like for example, today I want to trade. Let's imagine today it is at 9 a.m. It is 9 a.m. I would run my ML model and let it predict my high and low. And over the day, I would observe if a stock is going above my high. In case if it did, I would want to take a short position. Let's say if it fell below the low that was predicted by my ML model, I would take a buy position, because I'm assuming that, or I'm hoping over the next few days, since it is an overreaction on either side, it's going to correct back and come back to the range my ML model had predicted. So this is an idea. No way we are telling you this is a rock solid strategy. My whole idea is to just take up a concept or a hunch and see how I can implement ML model in that in a logical fashion. I don't want to straightforwardly predict price, and I don't want any ML algorithm to do everything for me. I want my ML algorithm to add value to my own research. For that reason, this was added. So this is the thought process behind this strategy, or you must say implementation of ML for algo trading. And with this in mind, let's move ahead and see how it is implemented. I'm going to show you how it is implemented in Python, but as you could see on the screen, this is the workflow. So this is similar to the workflow I have shown you. So this is a generic workflow. Let me go to the end. This is a generic workflow where you start with the data and end with your predictions. But there are certain internal steps you do. For example, this is a final workflow I'm going to use, or the Python workflow I'm going to show you, where entire thing is divided into 4 steps. The first step is data preparation, the similar thing we discussed, where you get the data, do feature engineering, in the sense you create your indicators, let's say RSA, MACD, etc., and split my data into X and Y. So we're going to go into details once I open my notebooks, but yeah, on top, this is how it is. First you prepare your data, then you pre-process the data, like splitting the data and does your predictions. Like this is the place where you fit the model, optimize the model, everything. And once you have your predictions in your hand, then we will create signal, we will generate signals, basically buy and sell signals. With the thought process, we decided if the stock went above the high the model had predicted, we would take a shot, and if it the stock fell below the model's low, or predicted low predicted by the model, we would take a buy. So with that, we will create some signals, and then we will analyze how the strategy had performed. For example, Vivek had shown you comparing a strategy's performance with its benchmark. Similar study we could do, and also we would do certain trade level analytics, like what was the Sharpe ratio, what was the maximum loss, etc. So this is an example of how you can use ML, and let's dive into notebooks now, so that you can see how it is implemented in Python. So for Python implementation, I don't want to run each line. Rather, I would want to take you through these 4 big notebooks. And once I explain you the code and show you the results, I will also be able to explain you how to get access to those codes, and also how to practice by yourself. So let's go ahead. So Quantra is one of the products of QuantInsti, and Quantra basically has self-paced learning courses. We have 50+ courses here across different concepts. And currently, I would want to take you to regression, trading with machine learning regression. So this is one of our courses on machine learning. And as I said, once the implementation is shown, I'm going to tell you how to get access to this portal and also to this course as well. And also the notebooks I'm going to show you. But as of now, this is the course, and this is the landing page of the course, where you know what can you expect from this course, etc., the syllabus, etc. Let me go to the course. Not sure if everybody knows about it, but Quantra courses are a combination of different ways of teaching. For example, there are videos where concepts are divided into with minute parts and clearly explained. And once you know the concepts, there are different ways you will be assessed, and also there are Python notebooks where you would go for the implementation of the concepts you learned. And there are all these things are divided into sections. Just to connect you to what we've been discussing, which is implementation of this ML model for predicting the high and low, and then doing your analysis on the strategy. Let's go to that particular section, which was in section 7. But as I said, once this implementation part is done, I'm going to tell you how to get access to all this. But let's go to this notebook, which is data preparation, which is already loaded here. So this is section 7, unit 4. I'm sorry. So where we are going to do data preparation, it's just like Vivek had shown you. We can import the data from Yahoo Finance, or we can also import the data from CSV if you have. For example, here, first I'm importing the libraries. Here I'm not using any complicated libraries. I'm just using pandas and numpy. And I'm importing data in the form of CSV. So let me give you a brief idea of where we are actually doing this. We are doing this in our Quantra portal in one of our courses. If you are using Quantra portal, you don't need to install Python. You don't need to do any setup. You don't even need to get the data. You have everything on our server. You just need to log into your account and you can directly start coding. And even data also, they are there in Quantra server, so you can directly import the data. So all these exercises I want to do on gold prices. I want to predict gold high and low, and then strategize something and think about how I can take advantage of the prediction by ML, and also see how my idea had performed. So for that, I have imported the gold prices, especially from 2013. The prices were imported, and then as we decided, okay, I'll also put this up on screen. I want to put this on screen because there's a simplistic representation of what happens. So once we get the data, we don't want to directly jump into ML model. We want to clean the data. First of all, we want to understand, is there any problem with the data? There are many ways to do. Just like Mr. Vivek had shown you, you can go for .describe. You can call describe method on the data, or you can also plot it and see. Because let's say there is a data missing. Visually, I can see, right? If I plot it, if there is a data missing, this is like a preliminary study of the data or checking of the data. And if there is an outlier, I would be able to see just by looking at the data. So for that reason, it's a good idea to first plot it, see if there are any issues. If there are none, then you can go and check the NaN values. So I didn't see any extreme outliers, etc. So I was like, okay, fine, let's just check if there are any NaN values if I missed. So you can, here we checked for NaN values, and the input data has open, high, low, close. So for open, high, low, close columns, there are no NaN values. So I'm happy with it. So I'm happy that when I'm checking my data, there are no issues. But now I want to do feature engineering. I don't want to directly use my raw data to the machine. I want to create features and also scale the features, get it into a single scale, and then send it to the model. So for that reason, I'm creating input parameters. You can call it features, you can call it attributes, you can call it anything. But these are essentially the things that you extract from your input prices. We have open, high, low, close. So from close, I'm extracting, here if you could see, I'm extracting a rolling mean, which is a moving average, and different types of moving averages. I'm also finding its correlation with the 3 days price, like moving average and the price correlate. You can be as creative as you could, or you can be as clear as you could if you know the problems in implementation, or if you are a manual trader, or if you could create this strategy manually. Like if you are doing the same study manually, what are all the things you would look at? You can have a bit of an idea and you can create those things. For example, here I would want to predict the difference between tomorrow's open and its possible high. So instead of directly predicting price, as I said, I could have directly given this data and asked it to predict high. But instead of doing that, let's be more nuanced and let's understand in terms of deviations. So I want to know what could be the difference between tomorrow's open and high. For that reason, I created something called STDU, like deviation on the upper side, deviation on the lower side, and also difference between current days open and previous days open. You can, this is called feature engineering. You can create n number of features like this. So this is your input set. In the sense, you can think of these as indicators. You can have n number of indicators. I would, if I'm creating, I would create different indicators so that my ML model would have information of the stock from different aspects, not only about price, from momentum, from volatility, from volume, from money flow, etc. So with that in mind, you create a number of features. And as we discussed, okay, let me go back. When we are discussing about data split, we divide it into input data set and output data set first. So that's what we have done here. So out of all the data we have, what are all the things you want to give as input to your model, and what are all the things you want model to predict? So for that, I want to give these as inputs, where I want model to predict these two things, like the deviation to the upper side and deviation to the lower side. If I have these, once market opens tomorrow, let's say tomorrow market opened at 100, and if this is my deviation, I can directly add this to my 100 and I would know where the predicted height. And if market opened at 100, and if this is the deviation to the lower side my model predicted, I can directly subtract this from 100, I would know my low. So for that reason, these are the things that can be categorized as outputs and the rest as inputs. For that reason, we have filtered these columns and saved as capital X. In general, this is a general terminology where you use capital X to represent your input parameters for model. And also output is divided into two parts, like yu. Small y is generally representing output. So yu represents deviation for the upside, yd represents deviation from the downside. So just to repeat, we haven't done anything. We just got the data, cleaned the data, created certain features, and split the data into x and y. The things you want to give to your model and the things you want your model to spill out. Now the next step is to divide into test and train. But yeah, this is it for this, the first part, where in the first part you just end by splitting the data in a way. And let's go to the next part. Next part is the very next notebook, section 7 unit 5, and that's this section 7 unit 5, where once your data is split, so basically I've saved the data here, as Vivek was showing you how to save as CSV. I've saved my price, whatever input parameters I've calculated, right? So I've saved this as CSV and imported into my next notebook, so that I can continue working on it. So first of all, again, there are lots of NaN values, because initially with this open high low close there were no NaN value, but later we used rolling calculations and extracted some data from this. So there were some NaN values that popped up. We don't want NaN values, because with that you can't move ahead with your ML model. So we just dropped the rows with NaN values and made sure there are no NaN values. Basically we just dropped the NaN values using this method, and then later we were checking that to make sure there are no NaN values. And now this is the thing that was actually done in the previous thing also, just to show you the input and output parameters. So these are the input parameters, like input data, and these are the outputs you want. So we would give this to a model, and we want to train a model by giving this, and we want that model to predict our deviation to the upside. We want another model to do the same thing, like we will give these as inputs and we want it to predict to the downside. So this is the basic idea of what's happening here with the data, at least. But as we decided, we don't want to, like, for example, if you see the data here, so this particular data set is at a degree of 0.3, 1.8. This didn't go above 10, but here if you see, the prices are around 130, it's more than 100. So these are almost 100 times more than what these prices are. So this is not the structure we want to give it to a model. We want to bring everything into a single scale. For that reason, you would do scaling. And let me go to this again for the revision. And we want to do scaling and then train the model. We want to pass scaled data to your model. You scale the data, split it into train and give to your model, and then does optimization. So these can be done separately, or you can also create a pipeline. Again, there is another technical term. Pipeline is nothing but a series of, or a sequence of actions you do in ML. For example, I can call this as a pipeline where I'm doing these 3 steps. If you could come up with a function or a method that does these 3 steps step by step, I can call it as a pipeline. But in general, whenever we are scaling the data, fitting the model, doing optimization like hyperparameter tuning of the model, that would be taken as a pipeline, because this you can repeat it many times without doing individually. So that's what happening here. Again, you would get access to this. You can refer to what's written here. But essentially, we are scaling and we are finding hyperparameters for our model, and we defined a pipeline for that. If you could see, these are the steps in a pipeline. First, it's going to scale the data, and then it's going to fit the data to your model. So we define it like this, and does the parameter tuning where, for example, here we want to try with an intercept of 0 and also with 1. So what happens? It's this particular parameter tuning would run the model with 0 and also with 1 and find the one which has highest accuracy. So that's what happens when you're optimizing. But the important step is what data you're giving into your model. As we said, we don't want the student to know everything while he's learning. We want the student to know only the training data, a part of your textbook, and then we want to test it, or test the student whether he is doing things right or not, or he's taking decisions right or not. For that reason, we are going to take only 70% of the data. So this is what happening here. We are splitting the data into test and train. So first 70% of the data we are going to use to make the model learn, which is also called training. And rest of the data I can use it for testing, or I can see if the model is predicting or not. For example, here we have split the data. It's nothing but just multiplication like this, just a splitting, where you took the data and then using this particular square brackets with the split percentage 0.7, and so x train would be 70% of the x, and this is the input data, and you do the same thing for output also. So when you are splitting the data into test and train, you have input train data, output train data, and similarly you have input test data and output test data as well. So let me go back to this. So we have split the data, and now we want your model to learn. So you need to give the data to your model. This is called fitting, model fitting. So it's very easy. You just need to do model.fit. So what data you use to fit? You use your trained data to fit. It's like teaching the student by using a part of the textbook. So we are teaching the model with the part of the total data, which is trained data. So we are telling the model that these are all the things you need to look at, and you learn something, you find some patterns. I don't know what you do, but at the end of the day, you want to predict this. We already give it the solutions also, so that it can create its model. Basically, it can calculate its weights, etc. So it's going to get trained on this by also considering the output of the training data. So to keep it clear, so these are all the input data, and also this, okay, except these two, rest all the input data. So your model going to take these data, input data, and train or learn in such a way that it should predict this, and it's going to repeatedly do for all the data sets you give. Of course, that with the data set without 9 values, where we have dropped the value. But then, yeah, that's what happens when you say model learning or model fitting. And once that is done, you can use it for prediction. For example, yes. So so once the model is fit, this is where we are fitting the model. Once it is fit, you can then parse the test data as input. So just to repeat, you defined a model and you pass the training data to the model so that it will learn. It did learn, and now you want to predict. Now you will pass the test data's input parameters. So for example, if you think this is the test data, you just pass these values to the model and it's going to predict these two columns. That's what happens when you're using predict. So when you're using fit, you're going to do the entire data. You're going to tell the model these two are the output you want, and rest are all the inputs you're giving. It will learn from it. But when you're predicting, we don't know the output. It's almost like we want to predict tomorrow's data. So we don't have this data for us. We don't know how much they would be deviated tomorrow, but we have data till today, the rest of the columns. So we are going to give the rest of the columns, and that's what happens when you're predicting. And you can just call model.predict and it's going to predict. So this is the output. So we just want to test it how it happened in the past and also create some strategy for that reason. So these are all the inputs we gave, and these are the things that model had predicted. So with these inputs, model had predicted 0.52 and 0.53 as upper deviation and downward deviation. We're going to use this. We're going to use these predictions made by the model and create a strategy that happens in the next notebook, which is this is section 7 unit 5. So the next notebook would be the strategy analytics, which is already opened here. So this is a place where we are going to use these predictions. So model had close, high, low. Using this model had predicted, like for this particular day, by using all the input parameters, model had predicted this high and this low. So now we will see, could we have taken advantage of it by doing backtest? For example, as I said, I can write my trading rules like this. If the actual high is greater than the predicted high, so this is what the model had predicted and this is what the actual high was. I'm writing a condition that I would want to sell if the actual high is greater than the predicted high. Just like I had shown you here, I want my model to predict a high and a low, and in case if the real high is greater than the predicted high, I would want to sell, and in other case I would want to buy. So with this in mind, let's run this. So sorry, yeah, this is strategy analytics, yeah, and we do the same thing for buy also if the price is below the predicted low. And with this we generated signals, signals in the sense here is where we return the condition if the high is greater than the predicted high. So with these conditions we generated buy and sell signals, and this is how the returns are. So we can easily calculate, once we have signals we can calculate like Vivek was showing. So these are the returns where the green line shows how the strategy had performed. These are the cumulative returns of the strategy, and this is the performance of the gold over the period. This is almost like had you invested $1 at this particular date, and this is it would have turned into $1.2 had you invested in our strategy, and it would have stayed about $1 itself had you bought gold with that, because gold it kind of mean reverting over the day, but our strategy performance had risen over the day, or sorry, over the days. And this is how the strategy had performed. But no way I'm supporting or I'm asking you to trust this strategy. This is just a way of understanding how an ML can be used to implement in any case you could think of. As a trader, I know many of you guys are trading related books, but if you are a manual trader, especially if you are an intraday trader, you would be more focused on these nuances of market microstructure, and you might come up with your own theories or own observations, and you can definitely test those by creating a model to do that thinking for you. If you could teach it how you're thinking and what are all the input parameters you're using to think, that's the idea. And we don't yeah, you can actually stop here and once you see the performance, because yeah, this is like comparing with your benchmark itself, but you can also move ahead and do certain additional analytics, like you can also calculate the Sharpe ratio, and where it was 0.19, which is not that great, but at least it's not negative. And you can also do different analytics also. The code is here. You can definitely use this code, which is a straightforward calculation of profit and loss, etc. But yeah, eventually we are plotting things like where are we buying. So if you see this period, at this point we bought a position and we held for these many days and we closed it. Similarly, if you see this, and this date we took a long, held for these many days and closed it. The same thing for our short entry also. So over this period we didn't take any shorts, but we did few longs. So this is how we have taken long and sell positions or long and short positions in this particular contract by using the signals generated by ML. So if I had to do my trade analytics, I could actually do this detailed analytics of total number of longs taken, shorts taken, number of trades, profit per trade, all these things. Eventually I could see there is 57% of my trades were winners. But this is just an analysis, as I was saying. This is how you create a strategy also with an idea in mind and implementation of ML. But I would want to move ahead. Like all these things you could do with any strategy, is not specific to ML. With any strategy, you would do this performance analysis. But as the poll suggested, let's say 50% of you guys are not completely aware of ML or not completely comfortable using ML, comfortable in you coding for ML. So this is where our LLM comes in. And let me give you a brief idea of LLMs and take you through certain slides that are going to tell you how you can use LLMs just to code the notebooks I have shown you. I'm going to take the same example and I'm going to ask relevant questions, and let's see what ML tells us to do. And let's move ahead to LLMs for algo trading. Again, LLM means large language models. I'm sure you must have already heard about it, where these models, there are certain tools like OpenAI, ChatGPT, and Google's Bard, which were used to analyze and understand text basically. So people are using it for many ways. People are giving a part of text of a notebook or a part of text of a research paper as an input to the model and asking it to explain them. So basically you can use these, or the models will analyze and understand the text, and these models have capability to process the text as well, especially human like text. And this is a bit of an overview of LLMs, but let's take an example of ChatGPT, which is widely popular, as popular as BART, but of course most of the people are using ChatGPT. And yeah, as you must have already used it or known, there is naturally sounding response to these text prompts, and it almost sounds like some other person is speaking to you or written to you. And yeah, people in this trading community has been using it to understand trading concepts. For example, so far we have written, or we have read lots of books or blog articles on RSA. You could have asked ChatGPT also, or you can ask in detailed questions. Okay, why it is called overbought when it is above 70? Why not above 75? Why not above 80? These kind of questions you can't ask a blog or a book, but you can ask your ChatGPT or your LLM model. And what are they expecting? Like in finance community, what are the expectations on ChatGPT? Initially they want to understand news articles and social media posts. For example, if I have a big news article, I don't want to read on Apple, and I don't want to spend time on reading entire 3-4 pages of news article, but I want somebody to tell me whether I should whether the sentiment is negative or positive for Apple according to that article. So I can just copy paste that article into my LLM, and then it would come up with sentiment. And these kind of things you can also pass in your research reports and try to ask it relevant questions. And you can also create trading signals, but there are certain problems with that. I'm going to show you as we move forward. But yeah, it's going to help you to optimize the way you code. Yeah, I've written optimized trading strategies because that's what we are coding here. But yeah, with the data it had, with the data it's been trained on, you can ask questions on trading strategies and get better understanding. And of course, if you're developing through code, you can also develop or optimize your code. For example, let's understand if it really meant for finance or what are all the pitfalls. And let's ask certain prompts to ChatGPT and see what it responds. But to understand it better, let's take the same exercise, whatever exercise we had taken. And again, yeah, this is just a basic thing of ChatGPT. This is based on generative pre-trained transform architecture. It's basically a bunch of neural networks that are trained on large amount of data, which are trying to give you a context. If you set a context, it's going to be a appropriate and coherent response. But let's see how it responds with this prompt. And whatever we have covered in this webinar or in this part of the webinar, I want to ask it. I'm creating a linear regression model to predict the high and low of gold prices for the very next day. Can you give me complete pipeline to make the algorithm deployment ready, and give me a list of steps that need to be done as a quant would? So here I didn't ask it to code me. I just wanted to explain me what are all the steps I would want to take, because once I have an idea of it, I can ask relevant questions on the code. For example, this is a response I got. It just asking me to clean the data, prepare the data, train the model, do optimization of the model, create a pipeline, test the model, and then deploy it and do continuous improvement. This is the same thing we had discussed when we are discussing about a generic workflow of an AI or an ML algorithm in trading. And now I'm asking it a specific question. If you remember, we split our data into 70-30, but I want it to code for me. And when I asked it, give me Python code to split the input data for a linear regression model into test and train with a ratio of 70 and 30, it gave me this piece of code. So let us compare the code. Let us compare with what we had done and what it is asking us to do. This is a place where we were splitting the data. We defined the 0.7, the ratio with which we want to split, and we directly use this operator we could use from pandas, like data frame, square bracket, colon, and then the percentage or the ratio with which I want to split. With this, it will automatically give me 70% of the data, and this is a straightforward approach. But let's see what ChatGPT gave. And ChatGPT gave me a bit of a different code. it used another module called sklearn. From that, it called another method called try and test split, and it used that method. So there are multiple ways to do a certain action in coding. Here it has taken a standard way where you use the internal models that are available for ML, the most famous models like sklearn, or I'm sorry, packages like sklearn, and does this step. Yeah, you can also do this. This is the advantage of using ChatGPT. It can't code you complete trading strategy, but it's the better way is to first understand what should be done and ask it relevant questions to generate the code. And that's how you can use LLMs when you're creating your trading strategies, or especially when you're coding trading strategies. So entire thing so far we have covered on Python, but if you want to use other programming languages, of course you can use it, and you can also use your LLMs to help you with the coding. But don't directly use the code that generated by LLM. Understand the code so that you can learn. At the same time, you can deploy them better, because there might be some issue with the code. We never know until we run it. And yes, and yeah, there are a number of prompts I had added in this lecture, or sorry, in this part of the webinar. For example, I asked it, how can I understand performance of my ML model? And it gave me something. It asked me to evaluate the model. It asked me to do the back testing. I've done one of it. Like we have back tested it and did performance analysis. And you can also ask it questions. If you want to evaluate the model using precision or some AOC or ROC curves, you can ask it to give it a code. And you can also ask it to explain them better for you. And this is how best you use your availability of LLMs for your code. And yeah, we are almost at the end of the webinar, but I would want Kshitish to launch one more poll, and we are going to finish it in 5 minutes.
Sure,
Kshitish,
Varun. So the question is, can you completely trust large language models? Answer is are yes, absolutely, no risk involved, or no risks are involved. So very straightforward question. I would request everyone to participate in this quick poll. I can see 40% of the audience has already answered this. We'll wait for 10 more seconds probably. All right, let's close the poll now. So let me share the results. So 93% of the audience is saying no, risks are involved. Now we can resume with the presentation.
Thank you, Kshitish. And thank you guys for participating. And yes, of course, yeah, it is unanimous. Like, there are risks involved. But let's see, when we are trading, when we are doing our research, let's see what kind of risks are involved. And at the risk of being funny, let's ask ChatGPT itself, what are all the challenges and risks of using ChatGPT for ML-based algo trading? Let's see how self-aware it is. And yeah, it directly told us, yeah, it's been trained on limited data. It said, yeah, you can't be sure that I know everything about trading. I might be trained on limited data. And it also said that it lacks domain expertise. Of course, it is bringing certain things in combination. It's using ML into trading. It's trying to get the application, but there is no way an intellectual or a professional way to. It's not a professional to give you give you an idea or give you an advice on how you can use ML for algo trading, because it's not a domain expert. It's just using the corpus of input data it had and doing its neural network based calculations and spilling out the data, but spilling out the text for you or the code for you. So no way it had domain expertise. So I'm reinforcing this, because whenever you're reading something, better to refer the other papers also, and don't directly ask it trading strategies and directly use them. That's not how it is used. It should be used like the way I've shown you. And of course, it has limited interpretability. And even if it is doing mistakes, there is no way we are going to point out that there is a mistake. That's not possible. And yeah, it's trained on limited data. It's not like it's getting trained every single day. So recent information it might not have to give you better idea. For example, let me ask it a most relevant question. Let's say I want to compare financial statements of Apple and Microsoft for year of 2020. I asked it and it spewed out this data for me. It gave me this data. It gave me revenue of Apple, EPS, gross margin, net income, etc., etc. And it compared with Microsoft, and it looks like it did a pretty good job. But I was skeptical. So I thought, okay, 2020, it was saying Apple's EPA was $13.03. But then I went to Apple's website and I checked it, and it is wrong, and it is 3.28, but our model was showing 13.03, or ChatGPT was showing 13.03. So this is the reason. Don't blindly bank on ChatGPT or any other LLM model when it comes to numbers, especially like this. And of course, you can't ask it trading strategies because it's not a domain expert. So yeah, just want to tell you these limitations as well. And I would want to end the session by just telling you the resources. Yeah, you've gone through this 3-hour webinar, and I'm going to present you certain resources that's going to help you to better understand what were presented today and also kickstart your algo trading journey. So the first one I would want to show are books and blog by ChatGPT. I'm sorry, by QuantInsti. Sorry, I've been thinking about ChatGPT, but then books and blog of QuantInsti. Let me take you through the blog. So the link is blog.quantinsti.com. So as soon as the page lands, you see 3 books: Algo Trading, or a book on Algo Trading, book on Python basics. This particular book, which was book on Algo Trading, is very special. It had like highest number of downloads, almost 50K, and it's written by none other than Vivek Krishnamoorthy, co-authored, I guess. And this is not the only book Vivek created. He had created other books as well on Python and Python also. And again, this is a very, very interesting book. And this was entirely written by Mr. Vivek Krishnamoorthy. And there was another book on machine learning for trading. You can also look into this book. These are all free books you can download. And everything is explained very clearly with practical examples. And you can start with this. You can also go through a blog. There are thousands and thousands of blog articles which are divided into different parts, like different sections also. Like if you want Python for trading, you can click and you will get the blogs that are written especially for Python for trading. And as you could see, there are trending blogs also on that concept and also other blogs as well. And you can also go through anything. If you want anything, you can just search for it, and I'm sure QuantInsti blog had everything related to trading, almost everything, I must say. And then comes the Quantra. So the course you're seeing now is called Trading with Machine Learning Regression. So this is for Quantra. I'm going to show you how to get access to this, but let me take 15 seconds to explain what Quantra is. As I said, it's a portal where you have 50 plus self-paced courses. So if you go to the home page, you can directly go to browse courses, and it's going to give you a complete list of courses. These are all the courses we have, and these are also divided into different learning tracks. If you want to directly, if you are a beginner, you can start with this learning track, which is a combination of 9 courses. So you can go through this. This is a curriculum, you can go through this, but now I'm going to show you how you can get access to the current course which we discussed, or the notebooks on the course. So I'm going to log out and go to quantra.quantinsti.com and then search for the course Trading with Machine Learning Regression. And to get access to this, you might want to log in, and you can click on free preview. Once you click on free preview, it's going to ask you to register. And once you registered, you can directly take a free access to the course. For example, I'm logging in with an account. So you can take a free preview. Basically, you need to fill certain details, and after that, you will get a free preview. So I directly logged in using Google. I logged in with the email ID I never used, and directly it gave me access to the course. But not everything of the course is accessible. But of course, the things that were discussed in this webinar, the notebooks, etc., were already open for free preview. You can take a free preview. You can actually start with the first section and go through the video. There are other things also, importing data, and there are certain exercises also you could do on coding. For example, this is a coding exercise that's going to test you how you can, how well you can drop the missing values, etc. But guys, focus on section 7, where these things were kept open for you guys to look at. You guys can access this code, and you need not install anything. Directly you can load the notebooks and access it like we have seen. And this is one of the important resources that's going to help you. And the other one is Blueshift, which was covered clearly by Mr. Vivek. So these are all the publicly available resources you can use to start your algo trading journey right away. And there are free courses as well, which gives you complete access to the course. So as I said, you can go to our portal, go to browse courses, and then filter accordingly. You can scroll down and then filter. And even if you click on free, you will be shown a number of free courses you can take advantage of, or you can also select the category. So this is about the resources I wanted to tell you. And then yes, we can start our Q&A. I would hand over this to
Wow.
Mr.
Thank you so
Yes.
much for this wonderful presentation, Varun, and also taking our audience through various free resources that we have, which are very less, often talk about. So I would say amazing presentation, and I have also shortlisted some of the questions. So you can look at the questions from timestamp 7:45 since your session started. I have already shortlisted many of the questions which I have found. And meanwhile, you are looking at those questions. I would again like to highlight the fact that uh, as a part of 13th anniversary celebration, we are excited and we present you these exceptional offers which are active for next 24 hours only. And I am sharing again the links to these offers. So please make sure that if you are serious about learning algorithmic trading, so these are the resources you would want to explore, and these are the courses you would want to explore, right? So with make sure that you uh, get the highest benefit from these offers, because this is like once in a year that happens, that this is the anniversary offer, and on top of it there are exclusive offers for the attendees of today's workshop. So uh, please make sure you enroll in your favorite courses. Yeah, so now I think Varun, we can start off with the Q&A, and yeah, you can simply pick the questions that you think you want to answer.
Thank you, Siddharth. So let's start with the question by Mr. Pram. Is it possible to use PySpark or Hadoop Apache technology to trade the real-time stock data? Of course, yeah. When you're, especially when you want to use tick data or when you're using high frequency data, it's preferable to use certain databases or technologies that's going to help you to stream the data by collecting the data from the broker. Yes, you can definitely use, and you would want to check the limitations of these whatever tools you have mentioned here and the latency issues. If there are none, definitely they can be used. And yeah, of course, it's recommended to use certain databases and also streaming technologies. If I answered that question. So the other question by Mr. Louis. Mr. Louis' question was, which one is preferred, adjusted close versus close? So, and yeah, to read the complete question, it was said that noticing closing prices during the presentation using adjusted closing data, why using one standard, or is it a personal? So the data I've shown you was actually taken from a data provider who already does the adjusted close calculations and pass it as closed data. But if you do it in Yahoo Finance, it would give you closed data and adjusted closed data separately. Ideally, you would want to use adjusted closed data because it's going to incorporate whatever changes that happen to the price, like price splits, etc., which going to stop the data or clear the data from sudden outliers, right? So it's always preferable to adjusted close, but there are certain high quality data providers that does that adjustment to you and then provide as closed data. That's the reason in my presentation you see close, and in Vivek's presentation you see adjusted close as well. And then the next question is by Mr. Tushar. Yeah, it's a lengthy question and looks an interesting one. Let me read it out. What if company has manipulated the fundamental data, due to that the price is high and all other things looks good, but the company is actually doing some fraud? And so how would we be able to make machine learn these things and avoid this, as we have seen so many times in the market? Okay, this is interesting to share. And of course, what is said is right. There are companies with billions of dollars of market capitalization that had cooked their books and did some manipulation, and then yeah, they had wrong data projected as good fundamental data, and they have been caught. But the real question is how they were caught and who caught them. There are regulatory bodies that definitely have a look at these, and of course it looks like an outlier if the books are not right and the performance shown in the fundamental data is great. And there are certain checks used by these exchanges of the regulators, and of course they use machine learning. So right today we have seen an interesting case where you can use machine learning other than a straightforward way of predicting price. And of course for fraud detection and also anomaly detection also, these exchanges and regulators use machine learnings, and that's how they kind of keeps these kind of guys in check. Hope this was answered. Mr. Chris, what's the best accuracy achieved with the best model? This question, this is a tricky question because, for example, depends on scenario, but this looks like a standard answer, but no, this is a very detailed answer because depends on what are you trying to do. Are you trying to do classification or regression, or are you trying to predict volatility or price? For example, depending on what I'm predicting, I would want accuracy to be in a certain range. If I'm predicting price, I know I can't predict it 100%. And if I'm getting an accuracy of 60% also, I'm comfortable because that's the limitation I have with my trading strategy. So as you can observe, it depends on your trading strategy also. So it depends on what you're using, where you're using, why you're using, and how are you going to implement it in your trading. So with all these things in mind, the accuracy of the model is actually classified as good or no. But that's not the only thing you see when you are using ML for strategy creation. You would also see the strategy's performance, right? So there are different ways to understand whether it had performed well or not. It's actually useful to you. It's not only limited by accuracy of the model. Hope I've given you enough information to think about, Chris. And next one is by Purna. Mr. Purna is asking, is there a checklist to forecast if a trading session can be a volatile one? Of course. Purna, yes, you can do that. You can actually create a model to predict the volatility. So far, you have seen how to create a model to predict deviation. Today, we have done deviation, and you can also do it for volatility. You just need to calculate volatility, be it standard deviation of returns or any other way you are defining volatility. You calculate the volatility, give it as the output variable, and it's going to predict it. And if there is a sudden jump in volatility as per the predictions, you can say the next session can be a volatile one. But there is an interesting aspect of volatility. Volatility clusters together. You wouldn't see a drastic jump in volatility just like that. Prices might jump 10%, 20%. You don't see that kind of drastic change in volatility because volatility has a habit of clustering together. For that reason, if today is a high volatile day, tomorrow most probably would be a high volatile day, and today is a calm day, most probably tomorrow would not be a strong, would not be a highly volatile day. So that's one fundamental thing you need to keep in mind when you're using ML for this. And I hope I've answered that. Next question, Mr. Dhananjay, does ML count in the news which makes the sleepy stock very volatile? Oh, another question on volatility. You guys should definitely check our courses on volatility. And yes, so the question asks, question is, does ML count in the news which makes the sleepy stock very volatile? Definitely, because see, if you have enough data to train, if you have enough news, if you can use new NLP models in ML. We also have a course on NLP model where it teaches you how to use news data to predict the price, or use the price for trade, use the news for trading, or find the sentiment of a stock. You can use these kind of techniques, and if your training data had this instance where there was a stock which was not volatile at all, but there was a news and suddenly the volatile pumped up, and if it were well trained with this kind of data, definitely it's going to help you in predictions as well. And so the next question by Mr. Alex, machine learning is dependent on a data set. For a new product or IPO, is there an industry standard on how much historical data should exist before an ML can be effective in the context of strategy trading? What is your opinion? There is a standard answer for this, but since Alex asked about my opinion, if you think about it, maybe if you want, you're using Yahoo Finance or any other data source, it might give you data from 1980, which is, let's say, less than 40 years of data. And if you ask the same question to a data scientist, he might give you a bit of a different answer because they work with data of millions of rows and a huge data sets. But we don't have that luxury. We only have, we are a trader who uses daily data. We don't have that huge data sets. So that's the reason you don't even have great accuracy if you just focus on accuracy. So for that reason, if you ask me how effective is it, just don't use these things to predict the price. That's a very basic way to use and most inefficient way to use these ML models, the price prediction. And if you're doing price prediction, then the data is going to be a problem for you. But if you're not doing that, and if you're more nuanced, if you are dividing, if you are classifying the market into volatile, low volatile, trending, non-trending, etc., etc., if you are picking up these kind of interesting problems, the data we have is enough. And you can also explore data like minute data. If you're using minute data, and if you could get hold of minute data for, let's say, 10 years, you have enough number of data set and market scenarios to let the model train on different scenarios and also give you what you want, like the predictions of the classification. And nice question, Alex. And let me go to the next question. Okay, next question was with by Ajinkya. I am a data analyst working with Python and NumPy, Pandas, Matplotlib, SciPy. What I can do is only first part data preparation of ML model. Can I get a job in algo trading industry? This is actually, it depends on where you're applying job, because there are no standard quote unquote jobs. The job description might say you are a algo trader, or it might say you are a quantitative analyst, but you might be doing some other work. It might not complete you. It might also quote you as an ML engineer, but you might not do all these steps related to ML. You might, of course, data preparation is a very important part, and there are certain sections of certain hedge funds which are just dedicated to getting the data, cleaning the data, because that's the most important part. And there are more creative ways to convert the data and create features also. You might want to, if you have more details, you can write to our QuantInsti team and you would get more detailed answer for the same. And there are a few more questions. The next question is by Mr. Z10. How to choose the length of X test during actual implementation with live data? So X-test, here we used X-test because you can actually pass in single row also. You don't need to, when you're training, that's you want enough data. When you're testing, you're not doing anything but predicting, right? You do these predictions for two scenarios. First scenario, you would want to predict and see whether the accuracy is good or not. And in real life, since you're asking for live data, you just need to pass in a single row. You just need to pass data of whatever parameters, features you had for a single row, single day, and it's going to do your prediction because the rest were already trained, and the huge amount of data is already used for it to train. It's almost like passing, you found by in y is equal to mx plus c, you found m, you found c, and using n number of iterations. Now you just need an x. If you pass an x, and it's going to give you y. So that's the same thought process you need to understand when you are thinking in this kind of scenarios. And hope that was answered. And there was one more question by Mr. Gaurav Gandhi. How do you interpret your custom data with ChatGPT? So you can actually use APIs, and there are certain facilities given by ChatGPT, not just ChatGPT, other LLMs also. You can check in the website of ChatGPT or OpenAI, where you can also check API integration with ChatGPT, and that's where you can use the internal networks that were created by them to train your custom model. And yes, I've answered that. And so there was another question by Mr. Angad Singh. Sir, can we say that whichever time frame we trade, lower time frame gives us buy side liquidity when we want to buy, then sell, and higher time frame gives us sell side liquidity? Actually, this liquidity is not dependent on the time frames, because the market makers obviously, or most of the times, plays with lower liquidity, lower time frame only. They play in terms of milliseconds and seconds and minutes, not more than that. So they are providing liquidity in terms of lower time frames, and we are the ones who are taking actions in multiple time frames. So we have no effect on them, but their lower time frame activity had an effect on us and the market as well. So there is no relation unless you want to make a relation, but then most of the market making activity or liquidity providing activities happens in a lower time frame. I hope that was answered. And the next question by Mr. Amir Abbas was, is there any course about DRL in Q and PPO? Yes, I will just show you a course. On the screen itself, you can see deep reinforcement learning. You can check this course, and this is an advanced course. And yeah, it covers many things. Like this actually covers deep reinforcement learning. It's an extension of reinforcement learning where you also use neural networks. That's what makes it deep. In addition to reinforcement learning. Mr. Amrubas, you can check this course. You can also take a free preview, check how it is, and you can also speak to a course counselor to understand more about this course. And hope that is helpful. And next question by Anand Pavan Mandala. Are you okay? Having said that, these OpenAI MLMs has no finance domain expertise. Then can we explore finance domain Gen AI? Any inputs on FinGPT? Actually, there are many derivatives of these GPTs using financial data. It's almost like getting an API of GPT and then training with your custom data. You can explore this, but I'm not sure because I haven't tested them at any extreme. But I have an idea of this, but I haven't tested them. But all these things are kind of customized LLM models with the foundation of OpenAI ChatGPT. So yeah, you need to go through their website and also the limitations, and also test it by yourself to understand what are all the limitations. And the next question is Mr. Rizvi Sayed. Can options be used for predicting volatility, maybe using Greeks, and can be used to find the price of underlying ticker? So you would, okay, this is an interesting way to think. This particular user wants to predict the volatility of options and then predict the price of the underlying. So actually, this is a bit different because you want to use Greeks to predict the volatility of the option contract, which is an implied volatility, which is different from realized volatility you see from the underlying. So that's not a efficient way to do. Why don't you directly use the whatever model you want on the underlying itself, but then take Greeks as inputs as well. What I'm saying was make sure you predicting volatility to the underlying, but not on the options contracts of the underlying, because both are two different things. If you have any more additional questions on it, you can definitely reach out to us, Mr. Reach out to us, Rizvi Sayed, and we would be happy to help you. So next question is, this is a question by Mr. Nishit Kumar. The issue with LLM is that it gives inaccurate results to prompt with confidence. Do you agree? Absolutely agree. The worst thing than giving inaccurate results is giving it confidence. Of course, that's the problem with most of the LLMs. They give wrong results, but then they give with confidence, and we shouldn't be fooled by that. And we should always be careful when we are referencing to LLM, especially for trading when the money is at stake, and coding when the accuracy is very important. So
Varun, we will pick just one more questions. It's about time,
okay.
and we'll pick one last question, and then we will close today's workshop.
So there is this last question by Dino Su. When ML model is built to predict some characteristics for trading, I wonder if this can be part of a strategy and it can be backtested as one without ML. Of course. Today we have seen as a strategy where ML is integral part, but yes, there are certain you can actually use ML models to predict the characteristics of trading, as you said, or let's say you are using NLPs. Let's say you're using NLP and you're using these ML models to understand the sentiment of a model. So basically, you're just doing the research, and cutting down the research time by using ML models, and also improving the accuracy of whatever research methodologies you're using. but you're not directly using that for trading. That's a separate part. But without ML, you can create a trading strategy based on that. Hope you answered your question. The straightforward way to do it is, yeah, if you're using ML for research, but then doing implementation of strategy in without doing ML, yeah, that is also possible. So you're nowhere limited here. You can, whatever thought process you have, whatever problem statement you could find, you can definitely apply ML there. But the ones we have shown you here are the ones which has practical implementation which you can get your hands dirty on and try by yourself. That's the reason these were shown. But if you want to see how ML is used for other implementations, you can also see our learning tracks, and there are learning tracks as I was shown. I'll just quickly show you learning tracks. So you can directly go to browse courses, and there are learning tracks here like machine learning and deep learning, advanced ML models in trading. And this is going to show you different ways also how NLP models are used, how different language models are used for understanding the market or studying the news. I guess we are done with the Q&A, and if you guys have any additional question, you guys can definitely reach out to us through email. And
Yeah.
Kshitij, you can take over.
Yes. Thank you so much, Varun, for such a wonderful presentation. There are many questions which are here with us. I could not shortlist them, and we are running out of time. But a very good 3 hour workshop that we had. Thanks to two of our speakers, Vivek Krishnamurthy and Varun Pothula, covered entire concepts or fundamentals of algorithmic tradings to the advanced level, machine learning, and obviously this is not everything. This is just the scratch, and uh, I think this can be a good starting point for many of the enthusiasts or aspiring quants, and also to those experienced traders. There is a wealth of knowledge and content that is available on our platforms as shared by both Vivek and Varun, and I hope all of you will thoroughly enjoy this content. So yeah, again, I will just conclude this. Uh, Workshop today by thanking our speakers of the day and our audience. And just one point that I have to share, and that is, in case if your questions went unanswered, please make sure that you are sharing your questions at the end of this workshop in the survey that you are going to get. And also, in case if you are interested in getting all these resources which were shared during the session, please ask for them in the survey so that we know that there are enough number of people who are interested in accessing those Python notebooks. So we'll make sure that those the content pieces are uploaded online and shared with you in email or in some other format with all of the audiences. Yeah. With that said, thank you so much, everyone, and you guys have a wonderful day ahead.